There is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way.
For markets anyways, I think probably the next few months are going to be very choppy.
The market always moves ahead of the Fed.
The market dynamics and the market structure actually afford the ability to hedge really almost like never before.
We're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now. Equity futures on the S&P 500 positive by 0.2%. Monday looked a lot like Tuesday, squeezing out a day of gains right at the end of the session. In the bond market, pretty consistent. A rally, 4 consecutive days of yields dropping, down about 20 basis points at the front end on a 2-year. Over that period, down about 30 on a 10-year. We are 2 for 2 this week. ISM manufacturing, weaker than expected. JOLTS, job openings, lower than expected. A massive focus, a lot of weight being put on the ISM. A little bit later on this morning, Bramo, that's the one to watch.
You're asking a good question, which is 2 for 2. Is bad economic news going to be negative for equities? The answer is we don't know. And really, one thing that Jim Reed over at Deutsche Bank pointed out is even though you do have some of these wobbles on an entirety basis since we got back to trade after Memorial Day, stocks are only down about 0.25%. So it's not as though it's been a massive drawdown in response to some of the negative news.
But you can feel that tension. It's like that tug of war. You're going nowhere, but there's tons of tension in that rope right now. I think a great example of that is job openings yesterday. So let's look at the ratio of openings to unemployed people. That's east to 1.2. We know where that was at the peak of all of this. The ratio was 2 to 1. It was 2 to 1. It's come all the way back down to 1.2, the lowest since June 2021, and really, really close to where we were in 2019. So we've got to ask the following. Are we normalising, or are we going to a deep, dark place that we don't want to go to?
Which is part of what some people are saying with Andrew Hollenhorst calling for more rapid deceleration in some of the jobs growth. There's another potential option here, too. If we're going back to trend growth, are we pricing that in accurately? How do we price that with some of the megatrends that Wei Li was talking about, sort of overlaid on top of it? Struggling with that is also sort of giving people a sense of, OK, what do valuations look like after some of the run-up we've seen so far this year and last?
More data coming up later. The ADP report, one to watch. And, of course, the ISM services before that. You get a PMI too. And then Friday. It's the big one, isn't it? Payrolls Friday. The number looks like this. A sneak peek, 185. The previous number, 175. And a lot of strategists trying to work out what bad news actually is this coming Friday.
Although, is it going to be in the headline number or is it going to be in the revisions? An increasing focus on revisions, not just to the previous month, but also to what we're going to get this week, which is revisions to 2023 numbers. This has been something that has been giving people a sense of insecurity around the data. Mohamed El-Arian talking about this. We're data dependent on data that gets shifted around in that post facto. And so, yes, we're going to be focusing on what is bad news, but how do we understand the trends after we get some of the revisions that maybe reset some of the expectations akin to what we've seen over the past few years?
Would you like to talk about some volatility? Let's do that. Let's head over to India and talk about the Nifty 50, the benchmark equity market index over there. Today, biggest one-day rally since 2021. OK, yesterday, biggest one-day drop in about 4 years. We've been all over the place. And I think right now we're basically back to where we were on Friday. And we're still trying to work out what the future of things look like in that country politically.
So we're trying to figure out what the actual policy implications are. It highlights how, if we're concerned about the polling in our country, in the United States, polling in India after the election was incredibly inaccurate because it seemed to suggest a much bigger win for Narendra Modi. How he gets this coalition of allies in a way that he hasn't had to for years is going to really be important for policy. On a broader sense, though, it raises this question about political volatility in a broader scheme, not just in developed markets, not just in the United States, but globally.
Massive focus, lots of interest in that story. I can tell you in about 25 minutes from now, we'll catch up with the team on the ground in New Delhi. Looking forward to doing that. The scores this morning, a good morning and welcome to the programme. Your scores look like this. Equity futures on the S&P 500 positive by 0.2%. Yields a little bit higher after dropping for 4 straight days on a 10-year, 433.96. And we get closer and closer to that ECB rate decision / ECB rate cut. 108.71 on euro dollar. We're negative by about 0.1%. The lineup for this hour looks a little something like this. Emily Roland of John Hancock, passing on the bad news is good news narrative. We'll speak to Ed Al-Hussainy of Columbia Threadneedle as India's Modi clings to power, and Stephanie Roth of Wolfe Research expecting another slowdown in US jobs. We'll begin with our top story. Bond yields declining for 4 straight days coming into Wednesday, following another downside surprise on economic data. Emily Roland of John Hancock Investment Management writing this: we are not chasing the bad news is good news narrative. Eventually, bad news will just be bad news. Emily joins us now for more. Emily, how close are we to that point? Are we at that point right now?
Well, to your point, John, it's just been a couple of days here, but there's been some pretty notable cross-asset trends. We look at things like small cap equities. Yesterday, they were down over 1%, even with that decline in yields. Over the past month, we've seen the 10-year Treasury yield decline from 4.70 to 4.35, and small caps have not kept up with their large cap counterparts. Of course, the narrative that's been permeating the markets is small caps should be the biggest beneficiary of rates coming down because they have higher interest burdens. And as the cost of capital comes down, that'll be a positive for those small cap stocks that tend to be less profitable. We're just not seeing that play out. We're seeing cyclical stocks get hurt. So we're feeling kind of sniffs of the market reacting to, hey, maybe this isn't so great, and that the Fed pivoting is actually maybe not going to be for the best reason.
We're in new territory, and I need your help navigating it, Emily. I'm trying to work out the distinction between a welcome cooling in the data and an unwelcome deterioration. What does that look like come Friday?
Yeah, it's really tough. And I think it's right to be watching the labor market because we've seen some cracks forming. You mentioned the JOLTS job openings data this week falling to the lowest level since 2021. The labor market continues to normalize. The whisper numbers lower than that 180,000 consensus view on job gains this month. I think we could see jobs kind of join the string of weaker than expected data. We've had retail sales. Look at the Atlanta Fed GDP Now estimate. It was over 4% pretty recently for Q2, and now we're at 1.8%. So we're seeing a notable deceleration in the data. Now, if you look overseas, those economies are actually looking a little bit better than expected. So the U.S. may sort of draft off of better growth in areas like Europe. China PMIs overnight showed some strengthening. But we're going to have to see kind of when that point is. And I think looking at things like initial claims are going to give us a sense.
How do you understand the Fed's policy and sort of their response function at a time where you really codified a pivot party and you talked about how it was fueling a lot of the gains in markets? Maybe the Fed wasn't wrong to pivot. Maybe they're going to cut rates in July. This is the assumption of the likes of Andrew Hollenhorst and Steve Englander. Do you think that looks increasingly appropriate, that maybe they were onto something about a weakening in the economy?
Yeah, Lisa, we think they were onto something, but the party just started way too early. I don't know if you remember kegs and eggs back in our sorority days. Maybe you guys recall that. But, back in October, the Fed hinted at 3 cuts. And then I just thought of that. And then, the bond market extrapolated that to price in 6 cuts. So the party started a little bit early. And I think the challenge with that was that you had this massive loosening in financial conditions. You saw risk-taking take hold. And the better economic growth was a good thing, but it comes with a nasty side effect of higher inflation. And I think you saw that in the form of the resilience across the housing market, especially in the first quarter. So the Fed's got a challenge on their hands. Yes, inflation's coming down, but it's taking a lot longer than expected, thanks to the Fed's own sort of rhetoric back in the fall. So the Fed's sort of backed in a corner here. I think wage growth on Friday is going to give us some more clues on the inflationary backdrop, but it's probably going to be a little while here until we can see those cuts.
You're raising an interesting point about some of the optimism that was baked in that needs to come out. Where does it need to come out in particular in markets where you're looking at quality stocks, you're trying to stay away from cyclicals, and we're defining what does quality mean at a time where Nvidia to the moon trades like a meme stock and yet seems to be the biggest winner always?
Yeah, you've got to focus on the earnings, Lisa, in our opinion. And we would be looking to trim areas that are not profitable. We talked about small caps already. We would be fading that and continuing to lean into quality. We want to own companies with great balance sheets, lots of cash, but we also want to think about owning them at a reasonable price. You mentioned technology companies. Yes, the valuations are looking somewhat extreme. No late 1990s, but they're looking overbought, but the earnings are there. You look at NVIDIA, yes, the stock's up a lot, but the earnings are up over 400% year over year. So you've got to find those quality companies. We're finding it mostly in U.S. mega cap tech, communication services. We'd even be sprinkling in a little bit of utilities now to balance out that tech exposure.
We'll speak to Lisanne Sonders a little bit later, Lisa, of Charles Schwab. NVIDIA's correlation to the market was 0.95. It's now 0.3.
Oh, yeah.
What a change.
I mean, essentially, NVIDIA is no longer the market in the same kind of way. It's interesting. Emily was talking about 1999. Washington Crossing advisors, Chad Morganlander and Kevin Karen, came out and said, in both 1999 and today, the stock market exhibits strong momentum and herd mentality, particularly among, that's right, the largest, most valuable companies. So some people are drawing the analogy with 1999 in a more aggressive way.
What do you make, Emily, of that breakdown of the correlation between NVIDIA and the broader market?
Yeah, we think it's healthy. You know, again, you're seeing a bit of a broadening out here. Some more breadth is certainly a good thing. You know, it was time for those names to maybe take a little bit of a breather in terms of their dominance. It's still there. And again, it's a key reason for our emphasis on U.S. versus international equities, just that the fact that we have a massive exposure to tech here. That's where we're finding the most quality. But we would also be looking at areas like mid-cap stocks. If you look at the S&P 400 index, it's actually trading at the steepest discount to its large cap counterparts since the late 1990s right now. So we think that there's a nice opportunity to lean into mid-cap stocks, take advantage of that valuation discount, and also get exposure to areas like industrials, which are benefiting from onshoring and industrial production that's picking up in the United States.
Emily, help me out here. So basically, we start the conversation by talking about bad news is bad news and end it by saying lean into mid-caps. Can you make that work for us?
Yeah, so we're balancing that out. John, you know that we've also had an overweight to high-quality bonds here. We love the fact that bonds are giving you income, 5-6% income. Even if you've got to wait a little bit for the duration tailwind to kick in, you're still collecting income in an environment where we do think economic contraction's coming. It's hard to see it right now, so we want to maintain exposure to areas that are benefiting from fiscal spending that's going on. We're finding that in mid-cap equities. We want to have some offense in the portfolio, but we're balancing that out by collecting 5 to 6% income here in high-quality bonds. We like that trade, too.
Just before you go, can you tell us how important you think that ISM services number is a little bit later this morning, particularly given what we saw on Monday?
Yeah, I think it's very important. Markets are very sensitive to that right now. Retail sales disappointed. We are seeing cracks in the consumer. So we're going to need to see, how that side of the economy holds in here in a time where a lot of people are pushing back on higher prices.
Emily, thank you. Emily Roland there of John Hancock Investment Management. On the labour market, you mentioned Andrew Hollenhorst a few times this morning. Let's talk about the man from Citi. As the labour market moves from excess demand, too tight, to excess supply, too loose, there will be a period of seemingly normal balance. Is that where we are right now? We think this is where the labour market is now, and further weakening, including job losses, is likely in the coming months. This is quite amazing stuff coming out of Citi. Citi is sticking with it. July rate cut. We're going to see that weakness in the labour market over the next 2 months.
And other people are joining him right now because there has been this consistency to the negative revisions, to the downward shift. You talk about jolts, the ratio of job openings to unemployed individuals. 1.2 is basically pre-pandemic. And this goes to exactly Andrew Hollenhorst's point. This is a point in time that looks normal, but it is on a line that is moving. And that, I think, is what a lot of people are hooking into.
Is it normal, or are we going to a darker place? Bramo will discuss through the whole of this week. Tomorrow, look out for this. Veronica Clark from Citi joining us on the programme at 8:30 Eastern Time tomorrow morning. A conversation you don't want to miss. Equity futures right now on the S&P just about positive by 0.25%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Shares of Hewlett-Packard Enterprises surging in the pre-market. The company reported revenue that beat estimates and raised its outlook for the year. Increased demand for its servers and more availability of NVIDIA's chips led to a jump in its sales of AI systems. Hewlett-Packard has seen only modest gains this year, while its competitors Dell and Supermicro experienced big jumps in their share prices due to their booming AI server businesses. And Intel and Apollo are teaming up. The chip maker announcing that the private equity firm is acquiring a 49% equity interest in a joint venture related to Intel's Fab 34 for $11 billion. Apollo's co-president spoke to Bloomberg's Danny Berger at the Super Return Conference in Berlin.
These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming.
More from Apollo?
Absolutely more from Apollo. but in general, just the need for this type of capital is insatiable.
And celebrities and well-known brands were the target of a TikTok hack. The hackers sent a malicious link through private messages to hijack prominent accounts, including CNN. TikTok said it's taking steps to mitigate the incident and prevent it from happening again. TikTok's future in the U.S. is uncertain as its Chinese parent company ByteDance currently faces a deadline to sell the app or face a ban. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the program, oil markets under pressure.
We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the US.
We've had quite a slide over the last week. That conversation is just around the corner, live from New York City this morning. Good morning. Equity futures doing okay, positive here by 0.24% on the S&P 500. Got this message just moments ago. Sure seems like your guests are tilting very cautious, not just Emily Roland. Need some Jake Pawlowski to cheer me up.
Well, Jay Pawlowski used to have company in Neil Dutta, but no longer. So your one stalwart is Jay Pawlowski, who can come on and say buy everything. And Jay, if you're listening, call in, give us some optimism.
Jay's on like a bullish island right now. In the bond market, yields a little bit higher by a basis point, 433.96 on a US 10-year. Under surveillance this morning, oil markets under pressure.
Roughly 70% of global oil demand depends on the services sector and the consumer, as opposed to the goods sector and the industrial sector. We estimate that over the last 3 months or so, global oil markets have been building inventories by about 900 KBD, so moderate inventory builds.
Yeah.
I think it's a combination of upside surprises to supply in February and March in the US.
So here's the latest. Oil holding near 4-month lows. A surprise in US inventory data boosting supply concerns. The American Petroleum Institute reporting a rise in US crude stockpiles and gasoline inventories. Nadia Wiggen of Svelland Capital joins us now for more. Nadia, always great to get your perspective on these things. Lisa and I were talking about it yesterday. Is it demand? Is it supply? Is it a combination of both?
In our view, at Svelland Capital, the market's really focusing on the demand side of the issue. What OPEC communicated is that they will extend the cuts through Q3, but then they would like to bring back some oil in an orderly fashion in Q4 if demand merits it. Instead, the focus of the market has been on the fact that, oh, they're going to bring back oil, they're under pressure within the group, and therefore we might have an oversupply. And that's Svelland Capital. That's really not how we view the communication. And when you look at these surprises on the supply side, we haven't been surprised. You know, we had big winter outages in the US in January, and oil production came back in the US in February and March. So it's not really a surprise on that side, but the concern has been whether OPEC would be okay with this rising market share and if members would throw in the towel and leave like Angola did last year. The communication from this weekend from OPEC suggests the group is intact. They are discussing things openly, and if and when production comes back, it will be in an orderly fashion.
Can we just talk about demand a little bit more then? What are your baseline expectations for the next several quarters?
So we expect that demand will actually rise in the third quarter. We're not at a 2.2 million barrel per day increase expectation the way OPEC is, but neither are we as low as 1 million barrels per day. We probably see around for the year 1.6, 1.7 million barrels per day year-on-year demand growth. And in Q3, we should see that pop locally coming. The problem is that refinery margins have become much, much weaker. And coming out of maintenance season in China now, we're not seeing an expectation of a run boost, and we've actually seen run cuts. And this is where we need that first line of demand to come to the forefront and take up some of the overhang we've seen in the crude supply market in the last several weeks.
It's a bit too confusing for me to focus on the entire world and all of the demand just in one lump. So I want to break it down. You mentioned gasoline stockpiles, and John was talking about the build that we saw over the past week, jumping by 4 million barrels. How do you place that into the context of the increase in driving and the increase in travel that you just talked about? Is that really just because there were some power outages over the winter?
Part of it can be that. It's also a concern, what were the refinery run rates that produced that gasoline in the first place, right? As your kind of implied source of demand. And part of the concern has been that the refinery run rates have been quite low in the US since maintenance season. And that started to change last week. So the next set of data that we received this week on the EIA will be a very important telling sign if we really do have that demand, or if the economy is feeling pressure on a personal level. When we look last year, we had a lot of short covering in gasoline going into Memorial Day weekend. We're going to have that data result, this week now. And then the market was not convinced that demand was there and continued to short on the gasoline side basically until July or into the start of July. And that is where we're at this tipping point on, do we think there is actually healthy demand in the US for this summer right now?
Nadia, a number of people come on this show and say that they're bullish on energy, they're bullish on oil stocks in particular, in part because of the whole AI trend, that this is going to somehow increase demand in the very near term. We are seeing adoption in a number of places. Do you buy that? Do you have to calculate that at all into the demand forecasts, or is it all more traditional types of travel and domestic demand that typically has really fed into the supply-demand dynamic?
Right now, on the actual oil side, oil is still an expensive source of energy. So that incremental additional demand shouldn't come from oil immediately on the forefront. On the other hand, when we look at things that the Biden administration has done, we've actually had 100 factories built in the US. Those are building demand, and that's not just in terms of AI, in terms of the administration. On the marginal side, yes, if you're looking at that last source of demand, then oil does really matter. But still, relatively speaking, we should be looking at renewables. We should be looking at natural gas. We should be looking at coal costs first.
Let's talk about the cyclical signal, which essentially is what Lisa's getting at. What kind of signal can we take away from crude as a cyclical signal? I think in the same way about copper now as well. We used to refer to copper as Dr. Copper. I'm trying to work out if it still has a PhD in economics or whether it's a climate scientist now. Nadia, what is it?
Well, on the copper side, absolutely. That long-term story, very much intact, and that is being promoted by the AI picture. And that is where in the medium term, it can also have an impact on this overall oil cycle. But it's an even more important natural gas story and LNG story in that medium term, because we're dealing with grid power that will help it, not just backup generators based on diesel. So I think it's an even bigger story for natural gas and grid investments. And what do you need to build grids? You need copper, right? So it is an argument in that regard. And then finally, a little bit on the oil side.
Nadia, appreciate your input. Brent crude bouncing back. We're positive by about 1/3 on Brent. On WTI, up a quarter, 73.42 this morning on WTI crude. The move in crude sort of reinforcing the general mood off the back of the economic data over the last couple of days, right?
I think that that's a good way to characterize it, because right now, even as Nadia said in her notes, that it didn't really seem to justify the kind of reaction that we got from the OPEC Plus announcement, considering that they're keeping in place a lot of the production cuts through October. Yes, people are focusing on the other, the bringing things back online in order to confirm what we're currently seeing.
You wake up, you're looking for the risk of a slowdown. You search the screen for something red. Crude shining brightly for a few days.
You watching me?
You're like, economic slowdown. No, I think that's what a lot of people do. Coming up on the programme, we'll take a look at Indian equities bouncing back as India's Modi clings to power. That conversation just around the corner, live from New York City. This is Bloomberg. Three days of gains on the S&P 500, including very small days of gains Monday, Tuesday, right at the end of the session as well. Very similar sessions. Check out this morning's. We're positive by 0.2% on the S&P, on the Nasdaq up by about 0.4%, on the Russell up by about 0.15%. I have to say, Bramo, I think the equity market's kind of dazed and confused, doesn't know what to do with this economic data. The bond market is very, very set on what to do with this economic data. That's buy it, rally, yields lower. Yields look like this: 2-year, 10-year, 30-year. Retracing some of the move lower we've seen over the last few days. We're higher this morning by a basis point or two on a 2-year and a 10-year. Though, Lisa, we've seen a double-digit basis point move lower over the last 4 days.
You mentioned almost a 30 basis point move in just 4 sessions for the 10-year yields lower. That is the biggest going back to mid-December. There is conviction that, yes, we are going to be starting the rate cutting cycle. We're building in a greater expectation of the number of cuts. But also it seems like people are resetting longer term expectations in terms of longer term base rates as well. I mean, it's entire shifts as people sort of get this sort of starting gun to go by duration even.
It just feels like the bond market's at the mercy of the next economic data point. There's several of them a little bit later. We'll talk about them in just a moment. I just want to turn the page to foreign exchange. The euro shaping up as follows, going into the ECB tomorrow. Slightly negative by 0.1%, 108.66. If I'm on that governing council right now, this is a fight about July. It is not a fight about June. That is done and dusted, over with over the last several months. What does the next quarter look like for this central bank?
And how much do they really draw a parallel between the inflation that they're seeing in the euro region with what we're seeing in the United States? There's a real question, especially with hotter than expected data. That said, some cold water on that this morning with German employment coming in light. So you look at this scenario, how do they sort of look at, yes, inflation that's stubborn, but growth that's clearly decelerating? And frankly, it is the same issue that the U.S.'s Federal Reserve is going to be dealing with.
Germany seems to do what Germany keeps doing. That economic data is not great at all.
Exactly. At a
time. Kind of been the thing for a while, right?
Yeah, which raises this question, who's going to be the hawk and who's going to be the dove? And we've been talking about this in terms of usually Germany being the one, have restriction, et cetera. Are they going to be sort of arguing, look, we need a little bit of help? It's sort of a really interesting question at a time where the ECB doesn't have the luxury of acting as one economy in the same kind of way that the United States ostensibly does, even though a lot of people are saying it isn't really when you look under the hood.
How divided is that governing council going to be in the next 24 hours? Under surveillance this morning, a downside surprise to JOLTS data. US job openings hitting their lowest level since 2021. Another look at employment later this morning at 8:15 Eastern time. We'll get the ADP numbers. Plus, I think the big one for most of you out there, ISM services, Lisa, 10 a.m. Eastern.
I thought you were going to say the Bank of Canada decision. No, I'm kidding. ISM services, to me, really will be potentially the 1-2 punch of this week in terms of ISM manufacturing coming out. And then if services come in weak, do people come around to the idea that, yeah, we are decelerating, and now it's just a question of what is normalization versus true weakness? I just wonder, though, what this does to stocks. I mean, you started out saying it's bad news, bad news. It's bad news for the Russell 2000. Everything's bad news for them right now, pretty much, either way. But what about some of the big tech names? Are they sort of insulated in this way, or are we looking at sort of a 1999 moment that Julian Emmanuel was talking about, given the fact that we've seen this incredible run-up?
Well, before we get to the equity debate, let's just sit on The Economist. I don't think you settled that debate in any way, shape or form this week. We'll have the same conversation. Take yesterday, for example. You and I have talked about this a few times already this morning. Quits rate, held at the lowest level since 2020. Ratio of openings to unemployed people, talked about this a few times, 1.2, lowest since June 21, down from the peak of 2-to-1 and very, very close to the pre-pandemic norm. So you're going to have some people that say we're just normalizing, other people that say, yeah, that's what it looks like right now. We're going somewhere darker.
That's the reason why I think revisions are going to matter a lot. Remember back in 2022, when we got those revisions for that year, it totally shifted the narrative about how much resilience there was in the economy and how much inflationary pressures were building up and how much the employment market was tightening. Do we get a similar kind of move in reverse if we get, say, revisions that show a real decrease of jobs in 2023? That's the kind of thing that could actually settle that debate in a more material way, at least in terms of market action.
Much more on that debate throughout this week, particularly around payrolls this Friday. Let's turn to this story. President Biden in France, ahead of a state visit with President Emmanuel Macron. The president is set to mark the 80th anniversary of D-Day. Later this week, he'll meet with Ukrainian President Volodymyr Zelensky and deliver remarks on democracy and freedom before next week, the big G7. And I have to say, one thing that was talked about maybe a month, 2 months ago, and hasn't been talked about at all really over the last couple of weeks, what happens to Russian assets in European financial institutions? I'm thinking Belgium, I'm thinking France. What happens to them going into next week?
The Financial Times actually put out a piece saying that the rumor is that the U.S. is working with its allies in Europe to come up with some sort of loan backed by these assets that will then allow them to basically monetize those assets, the loan being indefinite and possibly something that can be, relieved at some point. It really does seem like this is getting increasingly pressing as the political imperative decreases, at least among a population in places like the U.S. and in Europe. So that, to me, is going to be a real question with some of these meetings, especially with the idea of Macron and Zelensky sort of paired together.
What is the loan against future income streams or something like that? Is that what it is?
It's something like that, where they can get away with it, basically saying if we have it for 50 years, we have an income stream of a certain amount, we can basically imply we can give you guys as much money as we want.
Watch this space. You're going to hear a lot about this in the next week or so. Let's turn to India. Lots of attention on this story. Narendra Modi vowing to continue as Prime Minister for a third term. Modi and his BJP party losing seats in Parliament despite exit polls, which fueled expectations for a super majority. The Prime Minister will now have to rely on a coalition for the first time. I'm pleased to say that we can catch up with Bloomberg's Menaka Doshi joining us from New Delhi. Menaka, can you give us the current state of play? What is going on and what's changing on the ground?
Well, good afternoon from New Delhi. The shock has worn off of that very weak mandate that Narendra Modi won. The outcome, as you described, coming as a very big surprise to investors. We've seen some recovery in India's stock markets, which sold off yesterday and have recouped some of those losses through the course of today. I think investors are coming to terms with the verdict and maybe even hoping that this could likely be a stable coalition because both the key alliance partners of the BJP, which is Modi's partner, have reiterated their loyalty to this coalition through the course of today. So they're expecting a stable government and policies similar to the policies of previous Modi governments. In short, that is fiscal discipline, continuing incremental reform measures, though, of course, the lack of a supermajority, as you called it, will curb this Modi government from any large reform processes. Now, that's how the markets have fared today. The rest of the investors from across the world, whether it's an Apple or a Samsung, will be watching to see how Narendra Modi addresses some key weaknesses in the Indian economy, which have contributed to this weak election verdict. For instance, very weak rural consumption and no pickup in private investment. We'll get to know more once the government is sworn in. We expect that to happen this weekend. That's what media reports locally are suggesting. And then we'll have cabinet formation. We'll know who the key economic ministers are, what accommodations have been made for these allies in this coalition government. And eventually the Indian budget will give us the best clue on what kind of economic policy Modi 3.0 will follow. Will it be close to the previous 2 terms or will it be a fresh start altogether?
We're all following your coverage and we appreciate it. Bloomberg's Menaka Doshi there on the ground in India's capital, breaking down the surprise election results and a surprise move in this equity market as well. A big move. Big pop today, biggest one since 21. Big drop yesterday, biggest drop since 2020.
And this goes to this question of expectations and the idea that the exit poll initially gave him the majority that people expected. So you saw that massive rally and then it all was taken away yesterday. So this is about expectations as much as it is about economic policies that really are a black box.
Let's continue the conversation. Ed Al-Hussainy of Columbia Threadneedle joins us now with some experience of EM sovereign debt ratings. Ed, let's get straight to it. Your notes. If you are a global supply chain manager at a company like Apple, waking up to the news you woke up to yesterday, looking at these results this morning, what are you thinking?
Yeah, you've got to be a little bit more nervous. The whole story in India going forward is leveraged to the infrastructure investment. India is catching up to East Asia. India is becoming more competitive vis-a-vis China, but that's going to take a lot of infrastructure investment, and a lot of these big ticket projects may now be on hold given this coalition construction.
You pointed something out, Ed, drawing a parallel between this election with Mexico, saying that there is a takeaway, which is investor nervousness about eroding governance. Can you give us a sense of what that means at a time where a growing number of people have come on this show saying emerging markets are going to benefit from some of the investment in some of the new technologies and looking to diversify away from China?
Yeah, that's right. I mean, fundamentally, the bedrock of policy is governance. It's predictability. It's the extent to which we can build institutions to facilitate that investment, particularly private sector investment. And in a lot of these emerging market economies, I mean, if you look at the last 20 years or so, investment and productivity have underwhelmed. India is a fantastic case in point where it grows 6, 7, 8% a year and yet is unable to generate jobs. It's unable to distribute that growth effectively. And unless you have those institutions in place, the forward-looking productivity story gets that much weaker. And on that front, across the EM world, the elections over the course of the past couple of weeks have been a little bit of a setback.
Is there an investment thesis that's longer term, more than the knee-jerk reactions that we've seen so far in Indian stock markets? Is there something that you're taking away, that you're shifting a little bit around the edges, your allocations?
Yeah, I mean, I'll speak to the corporate bond markets a little bit, which is where we have most of our exposures. India disproportionately, and I think in contrast to many major emerging markets, disproportionately borrows in local currency. So they're not as dependent on foreign investors as many of the other larger EMs. But however, in the dollar bond market, most of the issuers are, again, geared and leveraged towards the infrastructure story. Adani is a fantastic example of that. Port infrastructure, energy infrastructure. So far, the reaction there has been very muted, particularly relative to the equity market. But looking ahead, I think, your previous speaker noted the budget that's coming up. Those budget priorities are going to be very important in shaping our exposure.
Ed, can we just build on some of the outcomes, not just India, but also Mexico, as you both mentioned just a minute ago? In Mexico, we got a big majority and people are unhappy. In India, we don't get a big majority and people are unhappy. And I think for those of us that spend a lot of time in DM and not enough time in EM, tourists, not like yourself, we're trying to work out what do we actually want from these governments. What is it about India specifically when it comes to coalitions that is so negative for markets?
Let me come back to the story of institutions. I think in both Mexico and India, the narrative is this. If you have a government that's too powerful, and in Mexico is a case in point, it can erode the institutions that undergird that government. They're at the moment talking about potential constitutional reforms. They're talking about Supreme Court reforms. In India, at the same time, when you have a government that's leaning populist, the fact that they now have to form a coalition means they're going to be taking their eye off the ball on the economic issues and potentially pivoting more towards domestic, more nationalist issues. And this is a distraction really from a very significant challenge that India has over the coming decades. Again, lifting productivity, creating a job market that is much more efficient and effective. This is somewhere where India has lagged significantly. And so as investors, you sit back and you say, look, the through line here is institutional quality matters. In EMs, ultimately, we're underwriting the quality of policymaking, and these election outcomes make us take a little bit of a step back and reassess.
And I tell you, I think for a lot of people waking up this morning, listening to this conversation, they're not thinking about Mexico City. They're not thinking about New Delhi. They're not thinking about what's happening in South Africa. And you know where I'm going? They're thinking November in America, in Washington, D.C. Is there any read across here at all for you, Ed, for you and the team?
Look, I think trade policy is on the ballot in the U.S. There's been an important shift in U.S. trade policy over the course of the past several administrations that's been impacting EM. The relationship with China, particularly the economic relationship with China, is reshaping the opportunity set for emerging markets. And again, India and Mexico are at the center of that conversation. So yeah, I think the outcome of the election from an economic perspective will matter quite significantly, particularly for trade-exposed emerging markets. There's a good number of emerging markets that are relatively isolated. They're commodity traders. That's a separate story. But if you're part of the global manufacturing value chain, India is trying to move up in that space. Mexico, by virtue of being proximate to the U.S., is a very important part of that piece. For those economies, this is going to be a critical election. And I'll set aside the issues around what the Fed will do after the U.S. election as well, which will be critical for EM.
We'll save that for another day. Ed, thank you, sir. Ed Al-Hussainy there of Columbia Threadneedle, breaking it down for you. I was thinking more along the lines of erosion of governance, degradation of institutions, institutional resilience come November and beyond?
That is the one line that I've highlighted from Al-Hussainy. The idea investor nervousness about eroding governance is something that we hear a lot in the United States. Is that being priced in? What is the price for that?
How do you do that?
And this is something that people are grappling with at a time where it's sort of interesting. There's some people who don't mention it at all in their outlooks. And then you've got PIMCO's sort of 3 to 5 year outlook that had that as their first point, sort of underpinning why yields are structurally higher. To me, this is just sort of, again, it's sort of a mystery depending on people's view of, the future and just how significantly those governance aspects will be eroded.
Ray Dalio gave a nod to it, I think, a subtle nod to it overnight at the Greenwich Economic Forum. Look for those comments a little bit later. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. British Prime Minister Rishi Sunak and opposition Labour Party leader Keir Starmer sparred over taxes, the cost of living, and the country's health system in a televised debate ahead of a July 4th election. A YouGov poll of viewers found that Sunak just barely came out on top by 51% to 49%. Both contenders said they would maintain Britain's close ties with the United States if Donald Trump wins in November. The New York Stock Exchange and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. He says his exchange will try to entice companies seeking relief from increasing compliance costs at the NYSE and NASDAQ. And Elon Musk confirming he diverted artificial intelligence chips away from Tesla and to his X and XAI ventures. CNBC had reported that the billionaire redirected 12,000 of the NVIDIA GPUs originally slated for Tesla to X. In a series of posts on X, Musk wrote that Tesla had no place to put NVIDIA chips where they could be used, saying they would have just sat in a warehouse. Musk had posted back in April that Tesla was planning to spend around $10 billion on AI this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the programme, the labour market looking for balance.
I think the hard labor market data is really what is important to us. The soft data has been telling us that the economy stinks for quite a while now, and it's the hard data that is actually going to move the needle.
A story up next. You're watching Bloomberg Surveillance. Equities a little bit firmer, positive by 0.2% on the S&P. Under surveillance this morning, the labour market looking for balance.
I think the hard labor market data is really what is important to us, because when we look at the Fed's reaction function, we think it's becoming more asymmetric, meaning that the Fed is going to be more sensitive to weaker economic data than they are to continued strength. The soft data has been telling us that the economy stinks for quite a while now, and it's the hard data that is actually going to move the needle.
So here's the latest. Job openings falling to the lowest level in over 3 years, with more labour data ahead of payrolls on Friday. Stephanie Roth of Wolfe Research expecting, quote, another month of continued moderation in the labour market, albeit firm. We're looking for a below consensus payrolls print of 165, the consensus 185. Stephanie with us around a table in New York. Stephanie, good morning to you.
Good morning.
The difference between just normalisation and going to somewhere sort of sinister, dark and scary, what is the difference?
The difference is layoffs, and we're not really seeing any signs of that. So, I mean, if you look at historically, a payroll print of 165 has been the average over the past decade, and that's a really solid number. The concern is that we're all of a sudden going to sort of spiral into something that's more significant. But
we go
there's no
beyond
sign of
that. Why wouldn't you be concerned by that? Do you not
Because
see
profit
that in the
margins are fine.
ISM manufacturing disappointing? None of that stuff entertain you?
The measures of sentiment haven't been a great measure of the economy over the past year. If you look at consumer confidence, that would have told you we were in an outright recession for all of last year when consumer spending was fine. So, yeah, I mean, of course, you're starting to see a moderation, and these measures of sentiment measure month-over-month changes. And sure, you're seeing a moderation, but that's what you would be expecting for payrolls to go from an average of 250 to something in the 100s.
In the revisions, when you look back at the JOLTS in particular, you can see that basically it's been flatlining for the past 3 years in terms of job openings, really a downward shift that we've seen pretty consistently. Based on some of the revisions that have been coming in lower, could that shift your view about how sanguine things truly are right now?
I mean, if you rewind back to last year, we were talking about job openings being too high, and that was a problem, and that hurt the Fed. And now we're talking about the exact opposite, with job openings coming back down towards normal. So that's kind of a good thing. We want the labor market to normalize. Of course, everyone's going to start extrapolating on the trend and worry about that. But it all comes down to profit margins. And so far, margins are generally pretty good. And companies are unlikely to do layoffs unless their margins are really starting to get squeezed and they're forced to.
Well, they're good on the sort of averages, but when you dig under the hood, they're real winners and losers here. And you see that pretty consistently across the board. Smaller companies are the ones that typically employ more people, right? And they're the ones that have been hurting more. How quickly could this turn come? This is what Andrew Hollenhorst has been talking about.
I mean, and it could happen quickly, but the good thing is for the Fed, they have the liberty of being able to cut. Last year, inflation was way too high. If you started to see the cracks in the labor market, there was nothing the Fed could do. But this time, the Fed is able to be very reactionary to the labor market data, and that's why we think they're still going to be able to cut in September. Inflation's looking a little bit cooler, and we're starting to see signs that the economy's moderating.
Okay, not to go existential on you, but there's this question about how effective some of the rate hikes have been that the Fed effectuated, whether the rate hikes actually themselves have been slowing growth and inflation, or whether it's just simply the sort of year-over-year comps on the post-pandemic realities that we've been seeing. So how do we know that rate cuts are really going to have any effect when it hasn't really been percolating through the system all that much?
So there are parts of the economy that have been feeling it. A lot of it's small businesses. They're the ones that really struggle with higher financing costs. So to the extent that lower rates would help to improve their profit margins, that would certainly have an effect on the cyclical areas of the economy. Equipment spending has been weak. A lot of areas within CapEx that are particularly labor market sensitive are the areas that are sensitive to interest rates, and that's what would feel it. And the rest of the economy, especially on the consumer side, probably wouldn't see much of a difference. But that's kind of the point here.
How are you expecting the team over at the Federal Reserve, Chairman Powell, the FOMC, to engage with some of these themes next week?
It should be an interesting one. I think what we'll see is a continuation of kind of the same, although perhaps their tone will shift a little bit more dovishly. We're going to have CPI on the second day of that meeting, which will certainly set the tone.
Yep.
We're looking for 0.27% on core CPI, which would be consistent with a core PCE of 0.2%, which is a second month in a row of core PCE kind of close to their target.
So we are sufficiently restrictive right now, right? Not too restrictive? Sufficiently restrictive?
I would say sufficiently restrictive. I think the Fed should be cutting at some point this year in order to sort of reduce the risk of something bad going wrong, like last March, the banking crisis.
Put some numbers on this. What does that dot plot look like come Wednesday? In line with 1 or 2?
I think I'm looking for 2.
You're looking for 2?
Yeah.
September and again in December?
September and December, and I think that's what the Fed will pencil in as well.
Tougher question, 2025. When you start to really think about 25 and some of the policies that could be introduced that could really, really shape this economy over the next 12, 24 months and beyond?
So the two most important ones, arguably, are going to be tariffs and what happens from a labor market perspective in terms of immigration, right? So we had the executive order today that probably won't have a big, or yesterday, that probably won't have a big impact in terms of labor flows. If Trump is in the office, he'll probably restrict patrollees coming in, this humanitarian parole. That has been a really important support for labor supply, but labor demand will probably be soft enough by then that it might not be that inflationary.
Go ahead. I mean, just to bring it all together, I guess the question is, Al-Hussainy was on and he said, investors are nervous about eroding governance in emerging markets. Are we going to see the same kind of fear expressed in the United States in a serious way in both the economic numbers, but also with market reaction?
It is possible. I mean, the one thing is that Trump is fairly market sensitive. So if you start to see anything unravel from that perspective, I would imagine the dynamics will change. The second important piece of the puzzle for next year is going to be on tariff policy. It probably will get tied into a TCJA extension, so that probably won't happen until the end of 2025. So next year, you might not actually see the inflationary impacts. 2026 could be a different story, and that could be a much more challenging environment.
You said it. The greatest regulator of some of the former president's worst instincts was the S&P 500. Or for that White House, it was the Dow. It was to be the Dow. Yeah, that was the big focus.
Yeah, which is the reason why people say he might retrace if it's, sends the market down.
Maybe. Stephanie, it's good to see you. Thank you. Coming up in the next hour, your lineup absolutely stacked. Former Barclays CEO Bob Diamond, Bloomberg's Mario Parker, PIMCO's Rich Clarida, and Matt Brill of Invesco. From New York, this is Bloomberg.
the Fed really needs to think very long and hard about cutting rates when you have this degree of speculation still in the markets.
The Fed is going to be more sensitive to weaker economic data than they are to continued strength.
The Fed is cutting rates anytime soon, especially ahead of the election. Things have to slow down in a more pronounced way than they have done so far.
Equities are still well positioned, especially in the context of rate cuts coming.
Our view has been on the Fed that nothing changes until something changes. Very much sitting in that space very comfortably right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide, coming off the back of 3 days of gains on the S&P 500. Friday, Monday, Tuesday into Wednesday, equity futures positive by 0.2%, and we're coming off the back of quite a rally in the bond market, inspired by one thing: weaker than expected economic data so far this week. ISM manufacturing, onto job openings later on this morning, onto ADP, and Lisa, then the ISM services read.
What's been interesting, as you point out, stocks have eked out gains. But which stocks have eked out gains? It's been the S&P and the NASDAQ, not necessarily small caps. Small caps have kind of lost out regardless, because bad news is bad news for them. On a broader level, there is a question about if you get rate cuts, if you get declines in yields, does that support valuations where you are, even if it's for the wrong reason?
Bad news is good news for this Treasury market, right? Quite a drop. Double-digit basis point decline, 2-year through to 10-year over the last 4 days.
30 basis points, almost 28.6 basis points when you look at the 10-year Treasury, not to be overly pedantic about it. But this question of this is the longest stretch and the deepest stretch of declines that we've seen going back to December. Question is, for the longer term, does it matter that much? Does this really reset some of the appetite globally to go buy Treasuries, domestically to buy Treasuries at a time where there still are some of those questions percolating? To me, it just highlights again the lack of certainty that people have about the long-term paradigm as well as Fed policy and the response to data.
The dominant question in economics on Wall Street this morning and over the last 2 days is, what is normalization? Are we normalizing, or are we going somewhere bad? And we're trying to work that out. And not just us, of course. The FOMC's got to do the same thing next Wednesday when they produce a set of forecasts for the world to see.
Which is the reason why it's sort of questionable, as you mentioned last week. Are they going to do anything? Maybe they just sort of keep it the same, saying, we don't know. We will move as the data comes in. We do get a slew of data, including CPI, ahead of that meeting.
A week today, CPI and a Federal Reserve decision, Chairman Powell news conference, and a whole set of forecasts to get our hands around as well. Let's get our hands around this market at the moment. The scores look like this on the S&P 500, positive by 0.2%. Yields have been lower over the previous 4 days. We're higher this morning by a single basis point, 433.96. Plenty of checks on what's happening in the FX market ahead of the ECB tomorrow, Lisa. 108.69 on the euro dollar.
A lot of people are looking to understand what their guidance is for July, whether they're going to cut rates there. I do think, and I have to say, I got some hate mail about mentioning Bank of Canada with sort of a shrug of my shoulder.
Was the hate mail from Canada?
Yeah, basically saying, you're really going to dismiss us. I was actually serious, because this might be the first bank to cut rates, and it's kind of a 50-50 right now in markets. If they cut, what is the guide to the ECB? I care about Canada. It's always sort of interesting. It comes out. I always look at it.
Who are you looking at? What's their name? Who are you talking to? I feel like this is just for one
James.
person. James.
I'm watching Canada.
Okay.
There we go.
James, I'm watching Canada too. Thanks for watching. Appreciate it. Coming up this hour, we won't talk about Canada. Bob Diamond of Atlas Merchant Capital on the Fed's path forward. Bloomberg's Mario Parker as President Biden touches down in France. And PIMCO's Rich Clarida on a generational reset of bond yields. We begin with our top story, cooling labour market data reinforcing speculation the Fed will cut rates this year. Bob Diamond of Atlas Merchant Capital saying the market has caught up to reality on Fed rate cuts, saying, quote, any cuts they make in the second half will be minor. Bob joins us now for more. Bob, good morning.
Good morning, Jonathan.
The market's moved towards you. They were looking for 6 cuts this year. It was ridiculous. We're now looking for like 1 or 2. Can we just start with what you think of the recent economic data, the information we've sort of got our hands around over the last couple of days?
I think it's consistent with what we're seeing in the whole first half, which is if you look at the second half last year, then the numbers coming out were a little bit pleasing for economic growth, probably a little bit pleasing for inflation being lower than we expected, and the labor market continued to be very robust. You get into the first half of this year, and the economic numbers are probably a little bit weaker than we thought. The inflation numbers are a little bit higher than we had anticipated. And for the first time, we're seeing just a little bit of looseness in the labor market. I don't want to overstate that because I think, the labor market is still in very good shape. But I think in both cases, the economy is strong second half last year, you can't cut. Inflation a little bit higher than you want this half, you really can't cut. So, Jonathan, I think 25 basis points here or there, who knows, right? There's no precision in this. But by and large, I think the risk for the Fed, the risk for the chairman, is to cut too early before there's any economic weakness and then having to reverse course as inflation, begins to grow. So my sense is they're going to be patient. They're going to be, everyone's used this word data dependent. But until we see a weakness in the economy, or inflation really down to 2%, then they're just not going to cut.
Both the economy and the market have surprised a lot of people. I talked about expectations in January, where we were then, where we are now. Let's talk about where we were last spring.
Yep.
Last spring, if we were sat around this table, the majority of people were speaking to Lisa, to me, to Anne-Marie, and they were telling us that what we're going to see is a real tightening of financial conditions. Banks won't be able to lend as much anymore. Companies are going to suffer.
Yep.
Here we are 12 months later, credit spreads are super, super tight. And credit availability, particularly for large companies, is there and ready for everyone, even with rates of 5.5%. You've got your finger on the pulse of this. Have you been surprised by that, the availability of credit to this economy still with interest rates where they are?
By and large, no. And I think sometimes there's an advantage to travel. A lot of times there's not. But I spend a fair amount of time in the Middle East and in Asia. And when you listen to people there looking at what's going on in the U.S., it was, okay, waited too long on taming inflation, raised rates 550 basis points in 9 months. We all know the economy is going to collapse, and it's kind of like, really? Like, the economy is still there, the labor market's still there, and it's so clear to me that we have such a competitive advantage in this country with the depth and breadth of the financial services industry, and I think it's a real asset. Europe doesn't have it, China doesn't have it. Hedge funds, venture capital, private credit, all of these ways to get credit into the economy, into small businesses, into middle market businesses. We have many investments with Cascadia in Seattle and Austin, with Marshberry in Cleveland, investing in advisory platforms for middle market and family-owned businesses. And it is incredible how many angles we have to get credit out into the economy in this country relative to other countries. And I think it has, I think looking at the U.S. from outside, there's real admiration for how did we manage this with 550 basis points in 9 months and the economy has stayed relatively stable.
There also is a question underpinning that, which is how effective is Fed policy and really having any influence whatsoever on credit growth, et cetera. There's a theory that the economy has just been a whole lot more resilient to rates as they go up to 5.5%. Is anyone talking about how rate cuts won't necessarily have any effect whatsoever on the economy also, especially just peripheral ones, because of all of this credit creation already in the system?
I think there's a lot of people that have an axe to grind. If you're in commercial real estate, you want to see rates come down for kind of the sector that you're in. But you mentioned history, Jonathan. Yeah. If we take a more historical look, since 2008, the great financial crisis, 2008 until the Fed started raising rates, Fed funds averaged just under 1%. If you look at 2, 3, 4 decades prior to 2008, Fed funds would have averaged about 4%. So I think we're in a much more normal environment right now. And I think the worst thing that could happen is that we saw the Fed, if the Fed starts aggressively cutting rates, it's going to be because the economy is weak. And so that's not necessarily good news. So we're not rooting for Fed rate cuts, but we do think, if you look out over the next couple of years, rates in the 4 to 4.5%, 4.5 to 5% range is probably the logical explanation. A bit lower than here over time, but not below 4%.
We've been talking about is good news, bad news, bad news, bad news, bad news, good news. For smaller companies, it has been bad news regardless, it seems like, over the past couple of weeks. And for small banks, regional banks as well, in particular, the KBW index is down some 12% on the year, really down sharply over the past couple of sessions. Do you think that rate cuts will eventually be positive for these shares? Or do you think that there's some sort of structural issues with holdings and other potential challenges that just make it bad news is bad news for them no matter what?
We have a strategy to invest in regional banks, so I do have a bias here. We see a great opportunity. And you know, kind of if you turn that on its head and say you're a strong regional bank, you've addressed your capital issues, and we all know that higher interest rates were impacting their treasury portfolios as they have for every bank, and they've impacted loan provisions. But let's just, you know, pick an example of an investor like us investing in a strong regional bank, so the capital levels are fine, there's no issues with a portfolio, and then look forward. You're really doing well with interest rates at this level. Higher interest rates are really good for banks. And it's been a long time since we've seen loan demand like this. So the go-forward position for a strong regional bank is actually outstanding. The question is, will we see consolidation, which we believe we will, and are there strong banks, which we believe there are? Okay. And I think one of the great attributes for again, you go back to the depth and breadth of the financial services industry in the U.S., the fact that we have these regional and community banks providing a service that the larger banks can't to small family businesses is a real strength.
You talk about consolidation. I wonder how much is going to be consolidation and how much is going to be failures. Yesterday, there was Access Financial, the latest potential target of some bad research, and a lot of it stemmed around its commercial real estate holdings. Some people argue that lower rates will actually cause property prices to go down because it will allow more sales to kind of get unleashed in the market. Do you think that there's going to be a rash of failures, that basically it's sort of like people sniffing out cockroaches, and if they smell something that's not okay, they just pull their money, and that's sort of a self-fulfilling prophecy? Do you expect that kind of activity to sort of come back?
Well, I think in our view, one thing that is certain is that since 2008, when the regulators and the political leaders claimed that we will never see too big to fail again, the larger banks in the U.S. have gotten bigger, more concentrated, closer to government, and far more systemic. So they're safe, the economy is good, but it's in no one's interest to allow the larger banks to continue to acquire the smaller banks. What we think is appropriate is that we strengthen some of the strong regional banks, whether that it's the capital markets, whether it's Atlas Merchant Capital doing investments, to give them the capital levels that are necessary for them to acquire some of the banks that I think are too small to succeed. Really, really good banks that have been more like community banks that have had good, solid ROEs for decades. But in this environment with the shock in rates, they have to adjust their treasury portfolio. With the loan loss provisions, they have to adjust that. And the thing that is more permanent is the regulatory intrusion post-SVB will increase their costs around technology and KYC. So we do see an environment where consolidation is a positive and a natural as opposed to weekend failures and big banks taking them over at the last second.
We started this conversation by talking about some of the misconceptions people had from the outside looking in, from outside of America looking inside America. From inside the financial system, what do you think is the biggest misconception that people in Washington have about the world you work in?
I think they misunderstand what has happened over the last 14, 15 years since the financial crisis with larger, more concentrated, more systemic, the big four, the big eight, if you look at the top banks. I think, between the top 2 or 3 banks of Wells Fargo and Bank of America and JP Morgan, it's over 50% of the deposits. And we saw a recent report where if you take 4,500 banks in the U.S., JP Morgan alone is 20% of the profitability. So banks are more concentrated. And I think what they're missing is the value to the economy of having a strong, robust regional and community banking sector. And I think for us, that is an opportunity over the next couple of years. And I think the thing that is really, really key here that people miss is the go forward. If you are a healthy bank, the go forward with higher interest rates and loan demand is outstanding. The question is, are you ready to be investing and are you ready to be lending?
Precisely. What's the starting point? Bob, you're going to stick with us. Bob Diamond, sticking with us for the next 15 minutes or so. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. President Joe Biden landed in Paris this morning. He's in France to mark the 80th anniversary of the D-Day invasion. On Thursday, he'll visit hallowed ground near the beaches of Normandy, where rows of headstones mark the graves of U.S. soldiers who died to bring an end to World War II. He's speaking on Friday at Pointe du Hoc, a spot on the French coast where Army Rangers heroically scaled 100-foot seaside cliffs to overcome Nazi defenses. Shares of Dollar Tree rising in the pre-market, the retailer announcing earnings that beat estimates and saying it's exploring a sale or spin-off of Family Dollar. Less than a decade ago, Dollar Tree beat out its rival Dollar General to acquire Family Dollar in a roughly $9 billion deal. And eBay is dropping American Express cards as a payment option. The online marketplace says it's no longer accepting Amex because of what it says are unacceptably high fees, according to an email reviewed by Bloomberg. eBay plans to notify customers this week about the change, which is set to take effect August 17th. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process.
The latest from Washington, D.C. up next, live from New York City this morning. Good morning. From New York, welcome to the program. Equity futures positive by 0.2% on the S&P 500. Under surveillance this morning, President Biden's many battles.
Today, I'm announcing actions to bar migrants who cross our southern border unlawfully from receiving asylum. Migrants will be restricted from receiving asylum at our southern border unless they seek it after entering through an established lawful process. This action will help us gain control of our border, restore order into the process. This ban will remain in place until the number of people trying to enter illegally is reduced to a level that our system can effectively manage.
Here's the latest. One day after signing an executive order aimed at curbing migrant flows at the southern border, President Biden touching down in France to mark the 80th anniversary of D-Day, with plans to meet Emmanuel Macron and Ukraine's Volodymyr Zelensky later this week. Bloomberg's Mario Parker joins us from Washington for more. Mario, can you go through the list of items for the next 2 weeks that this president has to confront?
Yes, the list of items is a great way to put it, right? We've got the president in France this week. He comes back to Washington, D.C., immediately pivots back to Europe for the G7 as well on the week of June 13th or so. And so what you're seeing from the president, at least over the last couple of weeks, cumulatively, is he's going down, he's ticking a box on all of the things that he has to shore up ahead of the election, right? While these are geopolitical issues, with 5 months before the November election, there's nothing that doesn't have at least a hint of an effort toward the furtherance of him being reelected to the White House.
When you think about what's on the agenda for the next week or so, Mario, and then you compare it to the concerns of the electorate, there's not much crossover here. In America, the concern is the domestic economy and immigration. Abroad, that we're talking about Ukraine. Is that helpful or unhelpful for the sitting president next week?
Well, here's what's interesting about that, right? In the polls, Americans care much more, to your point, Jonathan, about what's going on at home, right? Domestic issues, the economy, inflation, the cost of housing, et cetera. Biden scores quite poorly relative to former President Donald Trump in the latest polls in those subjects. Where he does have a strength, though, is in terms of character issues, in terms of preserving democracy. And so what you see him doing, essentially, is playing to his strengths, right? He's essentially saying he's going overseas to rally support for Ukraine against Russia's aggression. He's last week quite publicly and full-throated, may I add, saying that he wants a peace deal a ceasefire between Israel and Hamas, right? The backdrop before that was his entreaties toward black voters. And so you see him trying to kind of tick off both his liabilities, but also play to some of his strengths with the hope that voters essentially will give him some credit there.
Just before the big debate later on this month, Mario, appreciate the coverage this morning from you and the team. Thank you. Mario Parker down in Washington, D.C. Bob Diamond back with us around the table for some final thoughts. Bob, we've got to talk about November. All the concerns that people are talking about, trade, tariffs, the erosion of governance. Lisa was talking about that a little bit earlier this morning. What are you concerned about? What's on the radar for you going into 25?
So I think, Jonathan, if there is a dark cloud, and I've been pretty positive when we were talking earlier on the depth, the breadth of the financial services industry here, the strength of the U.S. economy, the strength of the U.S. dollar relative to other. If there's a dark cloud, it's the debt levels. You know, when President Trump started his first term, so 7.5 years ago, between then and now, during the 4 Trump years and the 3.5, if you will, Biden years, the debt of this country has gone from 20 trillion to 36 trillion. And you can't say that was a bad economy. It was kind of a Goldilocks moment, right, of 7.5 years of a strong economy. So where are we going to go? It's not in the markets right now, Jonathan and Lisa. I don't think it's talked about a lot. But if there's a dark cloud over the next couple of years, it's how are we going to manage, you know, what changes are we going to make? I think the second piece of it is, no matter who is elected president, you know, out as far as we can see, what president is going to come in and say, you know, no more debt? It's kind of been the easy solution to spend. So I do worry about it. I think it's out there somewhere. Is it a year away? Is it 3 years away? Is this comes back to be an impact? I'm not sure, but I'm a little bit surprised it's not talked about more in the market. So.
Well, we talk about it plenty, probably too much, some people might say. We talk about it pretty much on a daily basis. And Steve Eisman of Neuberger Bergman, I just can hear him if he were sitting over there. He'd say, this is all hogwash. People have been talking about this for 40 years and they've been wrong. They've been late. I mean, it's not going to happen for 20 years, 30 years. It could happen, and then it doesn't really matter. It shouldn't be baked into the markets. Do you agree?
No. I mean, I think I do think that there's, you know, going to be consequences of the debt levels. And I think going from 20 trillion to 36 trillion, and, you know, economists will give you all kinds of different percentages of it's too high. And it's become a significant burden in terms of the, you know, balancing the budget each year. So I think it is going to have an impact on the U.S. economy over time, and I think it's going to have an impact on tax policy and other things. It's not discussed much in the market today.
How do you see it playing out? You've got some experience in the United Kingdom. We all do over the last couple of years, particularly all focused on what happened with Liz Truss. How do you see this ultimately playing out? Just a slow game where they've got to slowly respond to this and show the market they're serious about it? Or is it something where you see the market start to reject the policies that come out of the White House?
Listen, right now the dollar is very strong. I think, I don't have the data exactly, but I think we're at an all-time high, you know, relative to most competing currencies. And I think one of the implications, if I'm correct, that the debt levels are too high in the U.S. would be, is there an alternative to the dollar? And it's a legitimate question, but there is no legitimate alternative. Where are you going to go? I mean, Europe. I remember, Jonathan, in 1992, when I was with Morgan Stanley, we did the first euro-wide European currency bond for, of all people, the Bank of England. You know, there was a lot of hope that you'd have a single bond market across Europe. But today, you do euro bonds for Italy. You do them for Germany. You do them. So each one has different risks. And there's not an integrated capital markets in Europe. I think they look at what happens in the U.S. with hedge funds and venture capital and private capital, and they look at what happens in the U.S., you know, in the impact of that on the economy. And they don't even have an integrated bond market. If you look at China, they have absolutely no interest in the transparency or convertibility that's required. So I think it's a very, very legitimate question to look at an alternative for the dollar, but there is no legitimate alternative. So,
and that's the problem. When it hits the fan, What are you going to do? Bob, this is fantastic. Always great to see you, sir. Thank you.
Good to see you, Jonathan.
Bob Diamond of Atlas Merchant Capital. Equities right now just about positive on the S&P. Coming up shortly, don't miss this, PIMCO's Rich Clarida from New York. This is Bloomberg. Three days of gains on the S&P 500, really small days of gains, Monday, Tuesday. This is Wednesday's price action for you. Good morning. Equity futures positive by 0.25%, up 0.5% on the Nasdaq, 0.2% higher on a Russell 2000. That's the futures board. Turn a page to the bond market. 2-year, 10-year, 30-year looks like this. Yields higher by about a basis point on a 10-year. After yields declined for 4 consecutive sessions, we're back down to about 433.57 on a 2-year. Came close to 5% at the back end of May, all the way back down to about 478 on a 2-year yield, higher by a single basis point. Going into the ECB tomorrow, big focus on the Governing Council and the rate cut we're all expecting. It's about what they do after that, and the kind of guidance that President Lagarde may or may not provide in the news conference following that decision. Euro dollar right now, 108.63, negative by 0.1% on that currency pair. Under surveillance this morning, India's Narendra Modi vowing to stay on as Prime Minister. After his ruling party fell short of the votes required to govern alone, Modi will now have to rely on a coalition for the first time since he took office back in 2014. And Lisa, this market, let's just put it this way, surprised, whipsawed by the last couple of days.
Yesterday, stock selling off the most in 4 years. So yes, after then rebounding the most since 2021. So these are these sort of whipsaw actions that we have seen. And Al-Hussainy, I want to go back to this. We just have to sit on this. He said what it highlights, this move and what we saw over Mexico, for the opposite reason, as you pointed out, is investor nervousness about eroding governance. I'm glad that you raised this parallel with the United States and other developed markets. At what point does it start getting priced into markets?
I think it's so difficult to do. So difficult to do. I had someone ask me this yesterday. What about Fed independence? What does that look like? Fed independence. What if the president fires Chairman Powell? I said, sort of don't underestimate the power of the institution once you set into the Federal Reserve. Do you actually think that person's going to take the phone call from the president and start doing whatever they say? Don't underestimate that. But perception, and you know as well as I do, perception for financial markets is as important, if not more important, than reality sometimes, and that can do the initial damage, and it's very hard to repair once you do that damage.
If you start to undermine the concept of just how independent. You're absolutely correct. This raises a question, though. He has every right to remove the Fed chair and put a different Fed chair in. Question is, will he do that if that does cause some material sell-off in markets? As we were pointing out, Stephanie Roth talking about how, he tends to respond, the former President Trump tends to respond to market action.
I think we're all listening to Al-Hussainy in the last hour or so, all thinking the same thing, just thinking about November. Shares of Hewlett-Packard flying in the pre-market. Let's get that up on the screen. Demand for its AI servers fueling a big jump in sales, while it also raised its outlook for the year. HP has so far missed out on the AI server rally, which has spurred big gains at the likes of Dell and Supermicro. It's rallying this morning, big time.
I find this fascinating, especially because really we've seen the winners and the losers of who's adapting AI quickly enough. We've seen Salesforce fall out of bed because they can't monetize until 2025. And then you have the likes of Hewlett-Packard coming out and being able to monetize in a more significant way. That's what I'm watching in the months to come.
Up by 15%, just about, in the pre-market. Let's turn to that bond market rally, hitting pause after its biggest two-day gain this year on renewed optimism for Fed rate cuts. Equities outpacing bonds so far in 24, but PIMCO saying a, quote, generational reset on yields is set to spur a bond revival. The bond manager releasing its secular outlook saying active fixed income is positioned to perform well if there are no recessions, and even better if there are. Rich Clarida, PIMCO's global economic advisor and former Federal Reserve Vice Chairman, joins us now for more. Rich, good morning. It's great to see you.
As always, yeah.
Congratulations to you and the team for another fantastic read. I want to start with last year.
Yeah.
I was with you, the aftershock economy, and one of the big calls came from you. Just sort of getting back down to 2 point something at the Federal Reserve. Can we start with last year?
Yeah.
How happy were you with last year's outlook, and then we can build on the new outlook this year?
Well, as the author, of course, I'm proud of it. But I would say, yes, our call last year was what we called the 2 point something destination, which some folks, including maybe my former colleagues, thought was a bit flip. But it had a message, and the message was 5 or 6 is too high. But if inflation gets to 2 point something, that gets the Fed and the RAIN and other central banks to begin adjusting rates. The risks become more two-way. I think it happened sooner than many of us thought, but that actually has big impacts for looking ahead. The fact that central banks are no longer part of the problem, they're now part of potentially the solution. So that's an important difference in the macro landscape.
So we've got this new reality, and we've got this big reset in bond yields too. Can you tell us why this is so compelling on a multi-year outlook for you and the team now?
It's compelling simply because the last 15 years, and many of your viewers probably weren't in markets 15 years ago, the last 15 years, curves have been very flat, yields have been low, they were negative in Europe, and historically the yield on a bond is the best single predictor of the total return. And so an investor buying a bond is going to first look at the yield and then look at the risk and other characteristics. And so yields now, especially adjusted for inflation, are at levels that we haven't seen in 15 plus years. Plus, if you adjust for volatility and valuation, altogether it does make a compelling story.
For which aspects of fixed income? This has been one of the biggest disagreements that people have had.
Yeah.
There's been this rush into private capital, private credit. Yeah. There's been a rush into T-bills. Where is active management? Where should it focus within the fixed income sphere?
Well, and thank you for asking, Lisa, one of our key messages is that there are opportunities in private credit. This is a super secular trend. After the GFC, big banks, regulation, supervision was changed, and so a lot of credit intermediation occurs outside of banking, and so there are opportunities, but we do say in the essay that we do see froth and valuation in certain pockets of private credit, in particular, mid-market corporate lending. We think there are much better opportunities in asset-backed lending to the consumer whose balance sheet's in really good shape. So we think investors need to be discriminating. When it comes to more traditional bond, the key point now is that investors can get an equity-like return, 6 or 7%, without a lot of volatility or interest rate risk. So that's why our subtext is seize the yield advantage right now. So no longer is there a reach for yield. Investors should seize the yield advantage.
They've been seizing it all year.
Yeah.
And this is part of the problem, right? That we talk about the macro risks. And then there's a question of valuation risks. And I'm stealing your words. I'm just going to be very blunt about it. You talked about that earlier. So how do you sort of weigh that? It seems like that's right now the biggest struggle for markets that are not facing off with bad data.
Right.
They just are trying to figure out whether it justifies the valuations where they are.
Well, again, I think there's an element of the fact that the U.S. last year did outperform globally, and so there is a U.S. exceptionalism theme that is grounded in hard data, and it's natural for markets to put some probability that continues. What we point out in the essay, Lisa, however, is part of that U.S. exceptionalism was fueled by big budget deficits in a fully employed economy, and it's not clear how long that can go on. So I think that markets sometimes do get into these bandwagons. They do extrapolate, and maybe we're seeing a bit of that, especially, I would say, in some other markets.
There was a phrase you used, equity-like returns.
Yeah.
Generational reset in yields, equity-like returns. Why do you and the team think all of that merits a reversal of the traditional 60-40? How are you now thinking about this approach?
We think 60-40 has served investors very well, but at extremes in valuation, it's worth reassessing, right? So if you look at traditional equity valuation measures, the CAPE or Shiller price earnings ratio or whatever, equities are very expensive historically. No, that can continue. It did in the 90s. But we do think 60-40 is worth assessing when you get at extremes in valuation. Perhaps, when rates were negative in Europe 5 years ago, that was another opportunity to look in the other direction now. So the reset is not a mechanical chain you should pull, but it is important to step back and see if you want to adjust the portfolio given valuation.
So what, 70-30? How are we thinking about this? Just help me understand a little bit more.
Well, the traditional is 60 equities, 40 bonds. And so, as a shop that sells a lot of bonds, we think 40 equities, 60 bonds could look good for a lot of investors at these levels.
At these levels?
Yeah.
You mentioned the debt. Does the debt complicate that at all, the deficit?
It does, and I think probably what we were navigating, and like a lot of investors are navigating, is there's not really any debate, either among economists or investors, that the U.S. is on a sustainable fiscal path. We're not. The question is the day of reckoning next week? Is it in 3 years? Is it in November of this year? Is it in 10 years when the Social Security Trust Fund is exhausted? We don't know, and so we do, in the essay, emphasize that in most sovereign markets, in the advanced economies, interestingly enough, in the emerging world, because of all the challenges emerging market economies faced in decades past, they have much more sensible levels of debt relative to the economy than many advanced economies now. So that's another thing that we're looking at is a global opportunity set, not just focusing necessarily on the developed markets.
Should you accept a lower yield premium for, say, Apple than to lend to the United States for 30 years?
Well, as a former Treasury official, I do think at the end of the day that the Treasury will find a way to make its coupon payments one way or another. So I wouldn't sort of get into comparing the risk there.
So I know it's
at
difficult.
Least not at 7:30 in the morning.
Well, I mean, I'm trying to get to this idea of, on the margins, you're going to start to see odd distortions in the market. Sort of to sort of not necessarily have a Liz Truss moment. I mean, everyone comes out and says that's ridiculous.
I was trying to set you up for that.
I know, but the
thing is, you
want
a single security analysis. If you want that, go to the Swiss National Bank, Bramo. They'll tell you about Apple.
No, I'm not saying Apple in particular. You know my point.
Yeah,
You're sort of one of these high-rated corporate companies, but you're welcome. Well, so Liz Truss, there's this question about, at what point structurally do you start to see a real kind of retracement on the margins? It's not necessarily a breakdown entirely of the market.
Absolutely. And we are certainly attuned and attentive to the fact that in the Treasury market, over a 5-year horizon, we could have one or more of those moments. Our baseline view is, at least for the next 5 years, the reserve currency role of the dollar, the fact that the Treasury is the global reserve asset, that's what has been called an exorbitant privilege, and the U.S. is doing everything it can to take advantage of that privilege. But at least for a 5-year horizon, we would see those disruptions as not being permanent reshapings of the Treasury market, but maybe as a signal for Washington to get its act together.
Let's sit on Washington. Bob Diamond was sat in your chair just moments ago.
Great segment, by the way.
Thank you. Appreciate that. It's wonderful. We were talking about the election in November. You are a Trump appointee. You went to the Federal Reserve, confirmed by the Senate. You served as vice chair of the Federal Reserve.
Yeah.
There's now these concerns that the former president becomes the sitting president and starts to make some funky choices about the Federal Reserve leadership, and things start to change. We erode independence. Can you walk us through your experience of that confirmation process? What it was like sitting at the Federal Reserve through his tenure? And are we underestimating the power of the institution?
I think so, John, and here's why. The Fed really is an institution. It was created 100-plus years ago. In some ways, it has a very clunky, archaic structure. There are 19 people around the table, 12 of whom vote. Some are appointed and nominated by the president. Others are the Reserve Bank presidents. And what it means is that there's a lot of institutional both pride and inertia within the Federal Reserve System. So, for example, right now there are no vacancies on the Federal Reserve. At some point there will be, and of course Chair Powell's term ends in May of 2026. But until there's a vacancy, there's nothing for any president to do. Fed officials have very long terms, and there's not really any legal dispute that they can serve without the risk of being fired. And so that's not really an issue. But over time, any president can shape the Fed to the extent he or she can put people on the committee. But I can tell you, once you get inside that room, and at least in my day, in that building until the pandemic, you really are aware of both your institutional responsibility and that the history books are going to be looking back at you in terms of what did you do in terms of achieving price stability and maintaining maximum employment. And that's a pretty powerful incentive to do the right thing.
There's another kind of political interference with the Fed that maybe is less obvious and less maybe sexy than say, I'm beholden to you, I will do this. There's a question about whether the Fed will essentially be forced to lower rates to make the deficit more acceptable. Right, to basically finance the deficit. Will there be a sort of implicit monetization of the deficit in order to keep the market going on a certain pace? Could you foresee that as sort of likely?
Well, we have seen that across global history, and we saw that actually in U.S. history coming out of World War II. So the Fed basically capped interest rates to help the government pay down that huge World War II debt. And as I used to tell my students, World War II ended in 1945, but the Fed kept pegging interest rates till 1951. So yes, can it happen? Sure. Will it happen? Not likely, but of course, when there's a large stock of debt, there will be pressures on the Fed, probably from both sides of the aisle, to try to keep rates low. The Fed, I think, will resist that. But certainly, is there a risk? There's always a risk. I think the institution would resist that, but it is a risk.
What was it like when the tweet started? What was that like inside the FOMC when the tweet started that you were doing the wrong thing?
Well,
because you read them, I'm sure you did. You saw it.
Couldn't avoid it. I'm going to sound sort of like Joe Friday on Dragnet. Just doing my job. We were just doing our job. So we had a very clear. Interestingly, in 2018 and 19, the economy was in a really good place. Unemployment at a 50-year low, inflation right at 2%, wage gains at the bottom end of the distribution. So in some ways, it was a little bit disconcerting. Like, what's the problem? But so we just powered through it. It was an honor and a privilege to work with Jay and the committee during that period, and it really didn't factor in. But yeah, you couldn't help but notice it.
I remember a phrase you used. You used to talk about an ounce of protection is worth a pound of cure.
Yeah.
And that was because interest rates were very low. We were all worried about going into the next downturn without having the firepower to respond to it. Do you think that phrase applies to where we are right now, given the current economic data going into next week?
Well, this is what I would say on that. I do think there is path dependence in the following sense, that a decision that the central bank should make right now, in part, is a function of how we got to where we are. And the reality is inflation's been too damn high for 3 years. And so, at least if I were still on the committee, but I'm not, that would be a factor in thinking about such issues as when do you start cutting, how rapidly do you cut. And as Chris Waller, my former colleague and really admire Chris, has like to say, look, we have the ability now to be patient. The economy's in a good place, strong labor market. And so I think, to me, given the history that inflation's been too high, and given where the economy is right now, I would be in the mode of not being keen to either hike too soon or too rapidly, because I do think it's very important that this episode be an episode which is thought of as there was a temporary inflation shock. It's transitory. It took too long to unwind, but ultimately it was transitory.
T+3.
You really do have to make sure that the inflation genie, in terms of expectations, doesn't get out of the bottle. So I think that'd be the way I'd think about it.
Rich, this was a pleasure. Congratulations to you and the team for another fantastic read.
Thank you.
Really appreciate it. Thank you. Rich Clarida there of PIMCO. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira Hakez. Hey, Yahira.
Hi, John. Donald Trump wants the gag order related to his hush money trial lifted. The former president arguing the basis for limiting what he could say, quote, no longer exists after the jury convicted him of 34 felonies last week. Trump's lawyers said his First Amendment rights are especially important after President Joe Biden, Stormy Daniels, and Michael Cohen all commented on the verdict on social media. Trump's team wants the order lifted before the June 27th presidential debate. The New York Stock Exchange and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. Lee says his exchange will try to entice companies that are seeking relief from what he says are increasing compliance costs at the NYSE and NASDAQ. And in just a couple hours, Boeing and NASA are set to try again to launch the Starliner space taxi into orbit. After weeks of delays, the spacecraft is set to launch at 10:52 Eastern from Cape Canaveral. This mission, which will include 2 astronauts, is a key test for NASA to prove that Starliner can safely transport crew to the International Space Station. The delays have added pressure on Boeing, which has racked up roughly $1.5 billion in cost overruns on the program. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on the programme, taking on risk in credit.
The yield on a bond is the best single predictor of the total return. There are opportunities in private credit.
We'll talk about those opportunities next, live from New York. This is Bloomberg. Equities on the S&P positive here by a third of 1%. Under surveillance this morning, taking on risk in credit.
The yield on a bond is the best single predictor of the total return. And yields now, especially adjusted for inflation, are at levels that we haven't seen in 15 plus years. Plus, if you adjust for volatility and valuation, altogether it does make a compelling story. There are opportunities in private credit.
Let's talk about some of those opportunities in credit more broadly. Credit investors turning to bank bonds, unfazed by tight spreads and risks in the banking sector. Invesco's Matt Brill saying this: we've been adding to it with the expectation that banking fundamentals have been fixed, not completely, but certainly in much better shape. And with the economy now more likely to have the soft landing, it seems like we should have more rather than less. Matt joins us for more. Matt, good morning.
Good morning.
Let's talk about that soft landing call first. That's really the framework for ultimately this investment. Why is it more likely now?
Well, I'd heard it was called a unicorn and it could never possibly happen. There was no way we could get the soft landing, and here we are. And certainly feels like we haven't gotten it yet, but it's on the way. And we're not expecting the economy to fall off a cliff is the most important thing. And if we don't see the economy roll over here, banks prepared for the worst last year, and they're probably not going to get that. So I think that sets them up pretty well.
So, Matt Brill, let's imagine that Andrew Hollenhorst is sitting on the other end of the table there, and he says, actually, we've never seen a decline in unemployment that's just been sort of a step down and then just sort of sits there. So what would you have to see to really start thinking, okay, this isn't just a soft landing, something else?
Yeah, so, I think we do want to see some slowing, right? We do want to see that, but if it goes too far, yesterday's JOLTS, openings were a little bit alarming, but still very, very high. So we're still in a very good economy. I think if you see, something along the lines of just people no longer feeling like they can't hire back employees, that would be a concern of ours. But overall, corporations are making the right decisions in investing, and CapEx growth is pretty good. So it doesn't feel to us as if this is just about to stop.
People who worked at Credit Suisse are probably listening to this saying, where were you a couple of years ago? You're talking not just about bank bonds in general. You're talking about AT1s, the sort of convertible bonds that a lot of banks are forced to issue, particularly in Europe, to offset capital requirements. Is there an area, is this really where you want to focus sort of big banks and staying away from regionals that are still kind of buffeted by some other issues?
I think you can get kind of the national champions and stay in the AT1 space and do well. So you're talking about some of the biggest banks out of Europe that were essentially untouchable for a month or two last year. And everybody stepped back and said, what does an AT1 mean? Is it possible that you can have the equity still have value and yet I'm going to lose everything? That's just not supposed to be the way it's supposed to be.
Can I ask if you got an answer to that now?
No, we still don't. We still don't. But the documents that are being written are much clearer going forward to address that. So
when you look at those documents, what has changed?
Well, certainly it talks about the waterfall of who's going to take a loss and who it's very explicit who can and cannot take losses first. When in the UBS Credit Suisse situation, would not be allowed to happen in these docs going forward.
So this is a Europe call. Yeah. Can we talk about what you're doing domestically here in the United States? Lisa brought up small regional banks a little bit earlier. Are they sort of a head case that you want to leave to one side, or is there opportunity there?
There's opportunities there. Now, I think you still have to be very selective with what you're playing in there. But in general, the rising tide has lifted all boats there, where I think the Fed and their facilities they put in place to pledge, at par, not having to crystallize the losses really helped. A lot of concerns around commercial real estate. We view that as a very slow bleed that's going to happen. Companies have addressed it. If you look at the loan loss provisions for most of these big banks, they've already reserved for 10, 12, 15% losses within commercial real estate. So I think it's already been addressed. We're probably going to get there in terms of losses, but it's just going to be taking time. And you can look at preferreds in the U.S. space. You're getting 7.5% kind of for the big six preferreds. And regional banks in the senior space are closer to 6. So I like staying up in quality with the larger banks, but down in the capital structure with the preferreds.
Just sort of zooming out and finishing where we began, the sort of a soft landing backdrop. How much do you maybe not see this as the year of the bond, but agree with PIMCO that you can get equity-like returns in debt markets for the next 3 to 5 years?
Yeah, so I'm an active manager, so I certainly like their call that active management will win out from here. But I think we came into this year thinking it would be the year of the bond, and here we are 5 months in, and returns are basically flat on the indices, which they were down, so flat is starting to look like a little bit of a win. Going forward, we do believe there's significant money to be made within fixed income. You're likely going to get the Bank of Canada cut today. You're going to get the ECB probably cut tomorrow. So with signs like that cuts are on the way, I think it's sort of a wake-up call to everybody that this is actually going to happen. The soft landing can occur globally as well as domestically, And when that occurs, you're going to start to see all-in yields go lower and the total returns pick up.
We've got one viewer who really appreciates you. James, that was for you. Matt Brill of Invesco on the Bank of Canada there at the end of that conversation. Matt, it's good to see you.
You too.
Thank you, buddy. Thank you. Coming up next, in the next hour, Sonders of Charles Schwab, Ronald Jewsikow of Guggenheim, Tom Porcelli of PGIM Fixed Income, and BlackRock's Marilyn. That's all coming up next from New York. This is Bloomberg.
There is absolutely nothing in the data that indicates that things are actually slowing down in any perceptible way.
For markets anyways, I think probably the next few months are going to be very choppy.
The market always moves ahead of the Fed.
The market dynamics and the market structure actually afford the ability to hedge really almost like never before.
We're not really in a typical cycle. We're in a cycle that has been boosted by mega forces that we haven't seen before in terms of the magnitude.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. For our audience worldwide, all eyes on the calendar. It's one of those weeks you've got to keep returning to it. The economic data very much in focus. Looking ahead to ADP in about 15 minutes' time. Then it's on to the ISM services read a little bit later on this morning. And Andrew Hollenhorst of Citi is looking for more economic weakness. Lisa, this morning, the Fed is likely to conclude that the labour market has come into better balance. A soft jobs report Friday, as they expect, they go on to say, would create more urgency for the Fed to cut rates.
Urgency, the key word. They're still calling for that July rate cut, and other people are coming around to this idea. It goes to the fundamental question that you brought up earlier this morning, which is essentially, where are we on a normalizing path? Where are we in terms of weakening? I actually think ISM services might be the most important data point of the day. If it is weak, if it's not, then it'll be shrugged off as just sort of the mess that we've been seeing. But if it is weak, are we seeing some more consistent data showing a slowdown that then you have to start to extrapolate out the direction of where that's headed?
Will it actually settle any debates? Let's say it's weak a little bit later. You'll have people like Kelsey Barrow of JP Morgan who say the soft data overstates the weakness. Look to the hard data. So we'll look to the hard data. You'll get payrolls on Friday, might come out at about 150. We're looking for 185 in our survey. At least you'll still have people say, oh, we're normalising here. We're not going to some deep, dark, ugly place. We're just normalising.
Okay, here's my frustration with that, is that then you'll have people come on and say that the payrolls data is completely distorted by immigration and will be completely revised within 3 months. So it's very difficult to get a read on hard data that's moving as quickly as anything else. And then you have Fed officials who come out, including Patrick Harker of the Philadelphia Federal Reserve, saying actually he thinks that some of the soft data and frankly even just the anecdotal data has been more sort of prescient about what's going to come in the months to come. So when you put this together, I'm not sure, but when you get ISM data that might be softer than expected, plus a Bank of Canada rate cut, you could have suddenly a narrative shift, at least for a couple days.
Pick your journey. Choose one. Here are the scores right now. Equity futures on the S&P 500 positive by 1/3%. In the bond market, yields down for 4 consecutive days coming into Wednesday. We're just about unchanged on a 10-year at 4.3220. Talked about the move we've seen over the last 4 days. Equity market hasn't done much. We've had 2 days of grinding higher, and that grind has been like 1/10%. The bond market, we're talking about a 20 basis point move at the front end on twos lower, a 10-year by almost 30 basis points lower in 4 sessions.
It's just shocking the pace of it. I mean, this to me, we saw the pace in the opposite direction going up, right? With people suddenly saying, well, maybe things are hotter than expected. I keep thinking about Mohamed El-Erian. His voice is sort of ringing in my head. This is what happens when you have an uber data-dependent Fed without a framework. The market is just responding to every input that they get, and it will continue to. Is that going to be a problem? Well, it's only volatility when yields are going up or stock prices are going down. And when they come down, it's suddenly a path that you can bet on in a more concrete way.
You've noticed that, yeah?
100%.
Mohamed joining us Friday. Don't miss that. Here's the lineup for this morning for the next hour. Sonders at Charles Schwab on what she calls a bifurcating economy. Guggenheim's Ron Jewsikow on why he sees more pain coming for Tesla. And PGIM's Tom Porcelli on signs of an easing labour market. We begin with our big issue. All eyes on the US labour market as investors look for more signs signs the Fed can begin cutting. Liz Ann Sonders at Charles Schwab saying this: the jobs report Friday is obviously pivotal, but details are just as important as headlines. A weaker labour market likely holds the key to giving the green light to the Fed for easing. Liz Ann, I'm pleased to say, is with us this morning in studio. Liz Ann, good to see you.
Hey, nice to see you.
Great to catch up. The current market environment is brought to you by the letter K. Liz Ann Sonders. Liz Ann, what is the letter K? What's that all about?
You might remember earlier in the pandemic, the K-shaped recovery was sort of one of the big themes. But I think we're seeing it again, and it's across the spectrum of what's going on in the economy and also what's going on in the market. Whether it was the original spread between goods and services, now, nominal versus real, high income versus low income, large company, stronger balance sheets, less rate sensitive versus smaller companies. You see it in the spread and within consumer confidence. You even see it, you talked about soft data conflicting with hard data. How about soft data conflicting with other soft data? We remember we had the SP Global version of PMIs were hot on the upside. The market sold off. Only 2 weeks ago. Now we have the ISM version that is soft. So even within things like the soft data, you get these bifurcations. It's a tough environment.
Do you see reason for this bifurcation to endure?
Some of them, yes. I think the large company versus small company, maybe thought of another way, rate insensitive versus rate sensitive, given that so many large companies are earning more interest on their cash and they're paying on debt. So we're at an 18-year low in terms of net interest payments for U.S. corporations. I think that bifurcation will continue. What's interesting is in this recent move down in yields, it has not been to the significant benefit down the cap spectrum. And that's a bit opposite of what started to happen last October when yields came down. It provided a huge tailwind for the market overall, but particularly for small cap indexes. Russell 2000 outperforming, equal weight outperforming. This latest move back down in yields has not accrued to the benefit of small. And I think the shift is now toward, well, is this slowdown? What does it mean from a profitability perspective, not just a rate sensitivity perspective?
Basically, bad news is bad news for small caps, and good news might be bad news for small caps too if rates stay high. So either way, they seem to be in a weaker spot, and we've been talking about that this morning. Going forward, though, there is this issue of valuation, and that's, I think, sort of what's sticking in people's craw. Because, you could say, the economy is doing okay, but valuations have gone so high on a lot of assumptions, and frankly on the fact that the people who are buying them are wealthy Americans who are benefiting, who've gotten incredible interest payments that they've been able to deploy. So how do you understand valuations within a normalizing economy?
So I think you can look at overall market valuation. You look at the forward PE on the S&P, it's in the low 20s. But then if you parse out whether it's the Magnificent Seven or the largest 5 stocks or the largest 10 stocks or the Fab 4, you can segment it. You're looking at more than a 10 multiple point difference. So something closer to 30 for those small group of large cap stocks and down into the 16, 17 range, exclusive of a category like the Fab 4. So that's not a bad backdrop, particularly if and assuming inflation continues to come down. The sweet spot for valuations broadly, historical average of 18, 19 times, is when inflation is around that 2%, maybe not coincidentally around the Fed's target. So if we continue to move in that direction, that's broadly supportive of valuations, but clearly the richer valuations are up the cap spectrum. That's where the earnings growth has been most significant. But we're going to see a convergence this year where you've got, whether it's the Magnificent Seven, whether it's the Fab 4, seeing earnings growth rates trend down at the same time, sort of those stocks are trending up. And by the time you get to the second half of the year, you have less of a spread between the mega cap stocks valuation, earnings growth rates and the overall S&P.
This is a fascinating point. It's one that Washington Crossing advisors picked up on overnight. We had Chad Morgenlander and Kevin Karen writing that basically they see kind of a 1999 moment in some of these stocks. Not necessarily there's going to be a big sort of meltdown, but In other words, investors should consider rebalancing portfolios that drifted or selling overvalued stocks, acknowledging that extraordinary growth rates cannot persist indefinitely. Do you see this change of leadership meaning declines in some of those names, or just that they're going to be left behind as some of these others rotate
I think there is an opportunity for catch-up elsewhere in the market. There's also, for all the talk of resilience in the market this year, and it is at the index level. So I often show, and I put this on my Twitter feed every morning, the NASDAQ, as an example, is up, 11, 12% year to date, has had no more than a 7% maximum drawdown at any point year to date. But the average member within the NASDAQ has had an average maximum drawdown of 36% this year. So there's a lot of churn and rotation going on under the surface, rotational corrections. And that's, in essence, where you might find opportunity. But that tells a more accurate story of what's going on than the story you would hear if you're just looking at the index level because of that large cap bias. It's less extreme for the S&P, but even in the S&P, the average member maximum drawdown this year is 14%. So that's correction level. So I think that's maybe where opportunity presents itself.
Raises a question. I just wonder how vulnerable we are, given that NVIDIA is no longer doing the heavy lifting for the broader market.
Very good point.
There's a stat that you've got, and I shared it a little bit earlier this morning, and I think it's sort of something we all need to hear. The correlation of NVIDIA to the broader market was 0.95, and you say it's now 0.3. How vulnerable are we?
Well, it's not necessarily vulnerability for the overall market. It's just a simple fact that NVIDIA as a single stock doesn't have the power to drive the market. And that really just shifted around when they released their earnings. So I think it was the 4 days following the earnings release, which was in conjunction with the stock split release, the stock was up more than 20%. Yes, yet the S&P was down a little bit. That is a real world description of correlation coming down and how it manifested itself. And I think the NASDAQ was also flat in that period of time. So it just shows you that there's more dispersion within the market, even within groups like the Magnificent Seven, much more dispersion, much lower correlations. In essence, that suggests stock pickers kind of market, but there's also a lot of minefields you have to avoid given the statistic of 36% average drawdown for the...
Amazing. Learn something every time we speak. Thank you, Lisanne.
Thank you.
Appreciate it. Thank you. Lisanne Sonders there at Charles Schwab. Your equity market positive by 1/3% on the S&P with an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Indian Prime Minister Narendra Modi did not get the landslide victory predicted in exit polls, that outcome forcing him to rely on allies to form a government. He's gearing up to hold coalition talks after his party lost its majority in parliament. Since taking office a decade ago, Modi hasn't had to share power in the government and will likely have to make concessions to other parties. Shares of Dollar Tree falling in the pre-market, the retailer announcing earnings that beat estimates and saying it's exploring a sale or spin-off of Family Dollar. Less than a decade ago, Dollar Tree beat out its rival Dollar General to acquire Family Dollar in a roughly $9 billion deal. And Google parent Alphabet is naming Anat Ashkenazi as the new CFO and senior vice president. The move is effective starting July 31st. Ashkenazi joins from pharmaceutical company Eli Lilly. She spent more than 2 decades at the company. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the morning calls, plus Guggenheim's Ron Jewsikow on why he sees more pain coming for Tesla. That conversation just around the corner, and an ADP report just moments away. ADP report just seconds away. We're looking for 175. Mike McKee's with us. Mike, what's the number?
152, a disappointment perhaps for the markets. It is a sign that the economy does seem to be slowing to the extent that you take ADP seriously as an indicator. I want to back up on that and say this. I was talking to some people on Wall Street, some economists on Wall Street, and they say, don't look at ADP as a forecast for what's supposed to happen. Look at it as just an alternative number. We don't go to the ISM numbers and say, well, they were wrong in the same way we do about ADP. And if you look at ADP over the last year or so, it comes in pretty close. We'll see what happens this time. So 152 is the total number. Goods producing up by 3,000. Construction up by 32,000. Now that's interesting because the numbers have suggested, at least the job openings in JOLTS yesterday suggested construction was not hiring all that much. ADP says manufacturing dropped by 20,000. In the service providing area, 149,000 jobs total. Leisure and hospitality, only 12,000 of those. As always, education and health services, 46,000 jobs. Let's look at the pay numbers because, of course, they do their pay survey. Job stayers get a 5% change in median annual pay. Job changers, 7.8%. That does show there's still a bit of a premium if people are looking for new jobs. So that maybe works a little bit across purposes for the headline.
Pretty decent bump. 152 is the number. 175 was the estimate. We get people coming on saying it doesn't matter, and then the market moves on it. Just a marginal move, but a notable one. Not in equities, but in bonds. You can just turn the page to the bond board and we'll look at the 2-year, 10-year, 30-year. Yields were a little bit higher this morning. They're lower again by about a basis point. I know it's not much, Lisa, but it's a fifth day of yields grinding lower.
It's basically confirmation of the trend, which just shows you that people dismiss it until it confirms a trend. I do think, there isn't necessarily a correlation, but just to sort of point out that the revision for last month was also revised lower. So the trend line also gets lower. If someone is looking for anecdotal data to confirm a weakening bias, here you go.
Mike McKee, stick with us, sir. We've got more to talk about. We'll be looking ahead to that ISM services read a little bit later this morning. Then on to payrolls as well. Payrolls on Friday, 185 is the median estimate in our survey. We'll see if that sort of inches lower as we get closer to payrolls Friday. Maybe some of that dependent on jobless claims as well going into Thursday. Time now for the morning calls. First up, Stifel raising its price target on Hewlett-Packard Enterprise to 22. The analyst highlighting strong earnings results thanks to AI demand. Plus, HPE's expectation for a strong second half. That stock is up by 16%. Next up, Mizuho lowering its price target on ConocoPhillips to 132. The analyst saying the company's Marathon Oil acquisition is a positive for near-term cash flows, but dilutive for long-term inventory quality. And finally, Guggenheim sticking with its sell rating on Tesla. Analyst Ron Jewsikow citing the EV maker's push into self-driving as a massive growing pain, writing this: Tesla is increasingly an investment underpinned by autonomy, a challenging balancing act requiring investors to buy into a vision of the future with limited supporting evidence. I'm pleased to say that with us is Ron to talk about this call. Ron, let's talk about it. Top of the pile, autonomy. What's not to like from your perspective?
Yeah, I mean, I think we can all appreciate that autonomous driving is a massive opportunity. The ability to commercialize 3 trillion miles just in the U.S. alone is a huge opportunity. I think where we struggle is steady state economics. There tends to be more than one company. These aren't winner take all markets. We don't have any really supporting data for Tesla to bridge to when autonomous driving happens. And I think if we just go back 5 years, 2019, at Tesla's own autonomous event, we were expecting robo-taxis in 2020, 2021, and people were underwriting in the net present value of Tesla then. We would have robo-taxis at scale today. If you have these 5-year shifts in commercialization for robo-taxis, it cuts your net present value in half. So I think there's a lot of overconfidence in forecasting this. And for a business that we think is going to earn less than $2 this year, there's a significant implied value for robo-taxis, autonomous driving that we think is just going to take a lot longer to play out.
You've got to sell, price target of 126. We've also got to talk about the overall deterioration in the sector that you identify and we can all see ourselves. What is the path back to volume growth here, Ron? Where does it come from? Before we get into the future and all these bright, shiny things, what about sort of the nuts and bolts of where we are right now and where we're going?
Yeah, there is volume growth in one major region of the world, obviously China, where I think you're seeing competitive product, good prices, competitive with ICE vehicles, the pricing, internal combustion engine vehicles. For the rest of the world, it's tough because I think there's a mix of consumer adoption issues, range anxiety, things like that, but also demographic issues. I mean, if you look at the average buyer of vehicles in the U.S., it's historically old, and they're also less likely to adopt electric vehicles statistically. So I think there's some demographic shifts that will help. For Tesla specifically, returning to growth, new models next year will help at the margin, but ultimately we've seen that without cutting price, Tesla really cannot grow volumes at this point. It's pretty challenging.
Ron, is the volume story a Tesla problem or an electric vehicle problem more broadly?
I think in the US and Europe, it is a mix of both electric vehicle and Tesla. In China, it's a bit more of a Tesla problem just because the amount of competition in China is very fierce. You're seeing BYD putting out a car last week with 1,200 miles of range, basically New York to Miami, that is priced like Volkswagen, Nissan, et cetera's lowest price ICE vehicle. So I think China's unique where it's more of a Tesla specific problem. Western markets, it's electric vehicles are struggling currently. And I think that's going to take time to play out. We talked about the demographic shift that should help over time. But
there's also this issue of the Elon Musk problem. This is at least according to some people, particularly with the latest news being reported, where he basically said that he is just transferring all the chips that he's buying from NVIDIA over to X Corp and XAI, not to Tesla, because, as he said, Tesla had no place to put them. This sort of flies in the face of some of the AI adoption that we've been hearing about in Tesla. How much does this sort of move the needle for you in terms of your expectations for Tesla?
Yeah, I think during our discussions with investors, at least, I think what was most noteworthy about the headline yesterday is, was this done independently or not? Basically, were other executives and their board members aware, or was this a unilateral decision? Because that has much different ramifications for kind of even the Delaware court decision in terms of they deemed that Elon had control over Tesla despite not having actually equity control. Otherwise, it's going to be a debate in terms of the sourcing of AI talent, where it goes, whether it goes to XAI or whether it goes to Tesla, and the allocation of resources and time. I think it's a bit of an open question. It's really tough to have an answer on, but we are surprised how much implied value Tesla is getting for their autonomous and AI efforts without a lot of tangible data to support it.
It seems to be the core of your sell call. Can I just finish on the leadership question that sort of Lisa alluded to? We've got this shareholder meeting, I think on June 13th run. Where do you think we're going to be regarding Elon Musk and the leadership of this company at the end of this month?
Yeah, I would say what we've written is we expect the comp package to pass. Frankly, candidly, we think that it's kind of promises made, promises kept. And we expect the Texas reincorporation to fail. Ultimately, I think that means Elon stays. It's a bit tougher to say what that means for the comp package with respect to the Delaware courts. But I would be very surprised if Elon Musk is not the CEO of Tesla both a month and a year from now. It is ultimately the best funding mechanism for his AI goals and ambitions. It has the lowest cost of capital, I would imagine, of any of his ventures. They're private, but I would imagine Tesla has the lowest cost of capital, the best funding base, 26+ billion of cash to see this out. It's going to be a considerable cost to develop any of these autonomous and AI technologies.
Ron, appreciate your input, your perspective and opinion. Thank you, sir. Ron Jewsikow of Guggenheim on Tesla. Sal, 125 price target, trading at 176 right now in the pre-market. Stock is higher by 0.7%. Just a moment, we need to recap those numbers, Bramo, don't we? 152 on ADP. The call was for 175, at least the median estimate in our survey. Previous number, 188.
Yeah, and that was a downward revision from 192. Question here is, of course, the relevancy. But today, the fact that markets did move highlights the sort of nervousness and the balance of risks right now baked into markets, which raises this question. How high is the bar for a downward sell-off versus some sort of rally if we get an upside or downside surprise in ISM? In other words, are markets more sort of attuned to downside surprises because that's sort of the narrative shift that they're smelling out, or is it equally kind of volatile on either end?
Can I say they're nervous in either direction? Just because of the experience of the last 2 weeks. I'll just take the last 2 weeks. 2 weeks ago, Liz Ann Sonders said this. We had this PMI come out, S&P Global, and then we were talking about the economy being too hot, a re-acceleration again. 2 weeks later, we're meant to be measuring the same thing. The ISM comes in soft and everyone's like, whoa, whoa, slow down. And then everything just reinforces that. You look elsewhere, job openings, whatever it might be, quits. Job openings relative to how many people need a job, and then you start looking at what's happening in crude of all places. Narrative's going to go back and forth, back and forth. If we get confirmation of the trend, yes. If we don't, yes. We'll be hyper nervous to it.
Well, so who's trading, on any given data point? Who's trading on ADP? If you are trading on ADP, please write in. We would love to talk to you because that is really a key question also. What's driving some of the ping-ponging action that we've seen?
Well, if they were trading on it, it's changed in the last 5 minutes anyway. So for a moment, yields were down and they're back up again on a 2-year by a single basis point. It's exhausting, isn't it? Up next on the programme, PGIM's Tom Porcelli and BlackRock's Marilyn Watson. And we'll get the latest thoughts from Mike McKee, still with us around the table too, from New York. This is Bloomberg. We are 1 hour away from the opening bell. Equity futures are positive here by, let's call it 0.25% on the S&P 500. On the Nasdaq, up by 0.5%. Little bounce on the Russell, up 1/3 of 1%. In the bond market, plenty of volatility in the last 10 minutes or so when ADP dropped and yields went with it, down a basis point, now just about unchanged. On a 10-year, 432.59. We'll talk more about that data in just a moment. I want to turn to foreign exchange going into the ECB tomorrow. Talk more about this ECB decision throughout this week as well. Looking for that first rate cut from a major central bank. Not that the others aren't major, just I call these tier 1 central banks and then everyone else. I'm going to keep offending people in Switzerland. Okay,
just like dig
euro
your
dollar,
hole.
108.75, just about unchanged on the euro. We'll leave that there, all right? Because Switzerland already cut rates and they're major, important, I know. Under surveillance this morning, Intel announcing another investment program as it works to keep up with competitors. The chip maker agreeing to sell 49% of an Irish plant to Apollo Global Management for $11 billion. The deal bringing in much needed funding as the CEO, Pat Gelsinger, pursues an ambitious turnaround plan.
This, to me, actually is one of the more interesting stories because we always talk about infrastructure week. When is the government going to finance all these foundries and all of these chip production plants? It's going to allow the U.S. to have some of the more advanced technology. Is it really going to be, corporate USA, or is it going to be some of these private management funds that have pools and pools of cash that are looking for some AI exposure? You just wonder how much that's going to be the fuel to the next leg of the fire more than, company Joe Biden.
I don't know if I'm looking for it, but I'm just noticing it more and more. Every time there's some kind of deal, our friends at Apollo are like in the story. Have you noticed that too? Paramount, Apollo's like in the story, Apollo's in the story. You see it more and more.
They're massive. They've got their tentacles in a lot of things, and they have a lot of money. And when you have a lot of money, you can't do as many, or you can. But if you need to gain scale, you need to go big. And so you start to see them as sort of a major partner for some more significant companies and some significant projects that are, what are in all of our kind of eyesight, which raises the question how much of a role these companies are going to have in kind of financing that next tier of development that a lot of people have been counting on government financing for.
We're seeing it in the news flow, that's for sure. Good morning, Mark, Jim, Scott. We'll talk more about this.
Lots of shout-outs.
Shares of HPE Enterprise, they're watching, I know they are, set for the biggest gain since 2016, thanks to what else? AI. HPE's server business generating $3.87 billion in revenue. The company seeing a big jump in sales as demand for AI-oriented systems only grows stronger. HPE finally getting a slice of the market as its peers Dell and Supermicro Computer see significant year-to-date gains. It's quite a year-to-date run. Supermicro Computer up 171%. so far. Let's turn to the bond traders. Tilting dovish once again, piling into bets that the Fed could cut sooner than expected. Swaps now in pricing an initial 25 basis point cut in November, moving up expectations from December. This as investors keep an eye on US labour market data. ADP just moments ago coming in at 152,000 versus the estimate of 175 after yesterday's downside surprise. Job openings hitting their lowest level since 2021. Mike McKee put it all together going into payrolls on Friday.
I would just say it. Nobody knows nothing. The old William Goldman quote about Hollywood, because it was last week that we had a guest on this show, and I can't remember who it was, but I'm going to quote him because it was great. The Fed has a reaction function. The markets have an overreaction function. And the numbers that we've gotten recently have them overreacting to the idea of rate cuts. Now, that may happen. April may have been a turning point in the economy. We don't know. We don't have a lot of data yet. But at this point, everybody's buying into the idea that the Fed's going to cut rates sooner, that the economy is slowing significantly. But there's a lot of stuff on either side, you look at the JOLTS report yesterday, and everybody's focused on the lowest since 2021, but it's still 8 million, which is still way higher than the average before the pandemic. And we saw hiring go up in April by 16%, the second strongest since January of 2023. So the labor market, is it weak or not? I mean, are we going to see a strong number on Friday? ADP might suggest not, but I don't know. And the other thing I would say is we are maybe getting into this trend that we're going to see rate cuts. It's only a question of whether the Fed is joining in, because Bank of Canada today, 9:45 this morning, comes out with their decision, and they're expected to cut rates. And I don't know where you would put them in the major, minor, middle. But I expect her to defend them because Lisa is a big deal in Canada, as we know.
Tier 2. I'm going to say Tier 2. What I'm really nervous about doing is putting anyone in Tier 3. So I'm just going to tell you there's like Tier 1, which is ECB, Federal Reserve, BOJ, and then it's like Tier 2. And I'm not going to say who's in Tier 3.
It's like Bs
right?
in most schools that now count as pretty much Bs, Cs, Ds, and even
Just
Fs.
everyone gets a medal. Yeah. Participation. All right, everyone gets Tier 2.
Here we go.
Mike, here's the problem. Destination versus journey. I remember this phrase from Chairman Powell, we all do, in Jackson Hole in the last speech in August when he talked about navigating the stars under cloudy skies. How do we navigate the stars under these skies? So when you look at the ratio of openings to unemployed people sitting at 1.2, so we're back down to about 2021 levels, very close to where we were pre-pandemic, all the way down to 2 to 1 at its peak. So we're talking about a really hot labour market. We're trying to work out, are we just normalising, talking about 2019? We're on a journey to somewhere else, somewhere bad. How do you even know?
You don't. I mean, the evidence is that we are normalizing, and almost all the economic indicators suggest that we are normalizing. There are some red flags out there that people are watching, the number of bankruptcies and the number of people who are getting delinquent in their loans, but they're still not out of what would be called a normal range. The issue is, do they tip over that edge? And we don't know that, and that's one of the reasons that, as they say, economists and Wall Street have predicted 7 of the last 3 recessions. I mean, we're always looking at these numbers, and people pick some out and say we're gonna have a contraction, and once in a while they're right, and then they come on this show a lot, and we tell them that they were great.
No one's ever told me that before. Literally every day someone gives me that stat. Just want to throw that out there. I will say, though, there is this question going forward about the data and then the revisions. And I don't know if I'm making too much of this or not. I know Bloomberg Economics came out with talking about a potential 730,000 jobs eliminated from the labor force as reported in all of the revisions for 2023. Do you buy into this credence, this idea that the data's been messy? We've seen some pretty significant revisions in the past. It's been harder to get it right, and they're more likely to be in a significant downward trend than upward.
I was looking at the what they call the QCEW numbers this morning after that piece from Bloomberg Economics, and I don't know if I buy that we're going to have this massive revision, but certainly the data has been very messy. Ever since we got out of the pandemic, it's been very hard to know what the final number is going to be, because all of the seasonals have been interrupted and the patterns that we had have been interrupted. And you see data after data being revised more than they usually are. But it goes back to what's the ultimate goal here of everyone watching this data is to predict what the Fed's going to do. And the Fed can only deal with the data that it has. So you can look at the revisions, but you have to take the data that we have at face value when you're trying to predict what the Fed's going to do.
That decision a week today. Let's bring in the panel. Tom Porcelli of PGIM alongside BlackRock's Marilyn Watson. Marilyn, first to you. Let's go to the calendar. Later on this morning, we all know what we're looking for, ISM services. Do you expect that to confirm some of the weakness we've seen so far this week?
So as Michael McKee said, I mean, the data has become so highly scrutinized that we've seen quite big moves on very small amounts of data. In terms of the ISM, we actually think it's going to continue to show a relatively robust economy, particularly in terms of services. And so we think it's going to continue to show that actually, as most of the data is showing, that actually the economy is normalizing, it is decelerating, but in a sort of a bumpy way. So we're not taking too much store by the ISM today. Obviously, we have payrolls tomorrow. We have CPI next week, along with the FOMC, and there's plenty of data to come in the next few weeks as well. But we think that ISM is going to continue to show that actually overall the US economy remains relatively resilient.
Tom, we've heard that word so many times in the last 24 hours, normalising.
Yeah.
What is the distinction between a welcome cooling and an unwelcome deterioration?
Yeah, and I think this is the challenge for the Fed, right? Because I think it's really easy. I think the stat you highlighted, Jonathan, is spot on, right? If you look at the ratio of openings to unemployed, you're basically back to where you were pre-COVID. But what keeps it there? And I think what would actually help keep it there is for the Fed to start the process of removing some of the tightening. And I think that's the real challenge for them. I mean, when I look at, it's funny, the QCEW, which you mentioned earlier, to me, this is like one of these great metrics that no one really pays attention to. I mean, and if you take it at face value, which is basically used in the benchmark, right, revision for payrolls, it would suggest up to, 50,000 less jobs per month, right, last year. And that's not a small thing. And again, the smoothing of that is a little trickier. But again, just taking it at face value, I think it suggests that you're going to look at actually some lower numbers for last year. But I think thinking about where we are right now, I think what we have to keep in mind is there are an assortment of data that actually are suggesting that things are looking a little softer from a labor market perspective. Now, look, let me hasten to add, I think on Friday, I think you could probably see about 200,000 jobs being created. But when I look at something like, the small business survey, hiring intentions there, which, by the way, is comporting with actual data, hard data on what small business are doing from a hiring perspective, which is to say it is lower. If I look at, something like the labor differential from the Conference Board, which is also deteriorating, which, again, soft data, which is comporting with the hard data. The unemployment rate is up modestly, but it's up. So there are things that are actually suggesting that labor is slowing. And I think this is where the Fed comes into play. And I think this is why the Fed wants to start the process of taking back some of that tightening that they put in place.
Messy data was blamed for what some people say was the Fed error in 2022 of not hiking rates sooner. Do you think, looking back, that some of the messy data that's going to be revised heavily will be viewed as the reason for another Fed error, that they didn't cut soon enough?
And Lisa, I think that this is what's on the Fed's mind at this point. And I think this is why they actually want to start. Look, I think if we just take a step back, I think it's very easy to say that, you think about Powell and what they were trying to achieve. They stopped hiking rates in July when core was at 4.2%. I think that whole process, that whole thought process was built around, let's try to limit the downside from a labor market perspective as much as we can. And so I think that's already on their minds. And I think this is why the conversation of, hey, let's cut is happening even with, 2.8% core PCE.
Marilyn, this uncertainty really has led to this question of the incredible volatility that we've seen in markets and how things have been ping-ponging along with the narratives. You focus on flexibility and liquidity. Is that because you want to move on a dime in response to some of these data points?
It's because we think there are a huge number of opportunities out there, particularly in fixed income right now. You can lock in very, very attractive all-in yields, very attractive carry with very good liquidity and limited duration risk. But that being said, it's a very uncertain time in terms of the Fed. We do think they may start to cut rates at some point this year, but it's too early right now, we think, to tell exactly when. Likewise, we do have, obviously the ECB, we think are very likely to cut rates tomorrow, and then they're most likely to be data dependent as well. Bank of England may cut rates at some point in the near future, and again, will be very data dependent. And I think, as you say, a lot of the data is becoming sort of, as you say, quite messy. And as we do see this normalization and two-way risk coming in a lot of the data, whether it's the labor market, whether it's other economic activity such as manufacturing, consumption, retail sales, you name it. And so we do think it's important that we are flexible, that we can actually deploy money where we think we see the best opportunities. We want to lock in the best income that we can for clients, but we also want to protect against outside events. And as you say, we don't know a catalyst for the data to really swing dramatically one way or the other, but we want to be prepared, and we think that's very, very prudent at this stage in managing the portfolio. We want to be very, very risk aware, and we really want to understand exactly where the risks are in each position that we have, and be aware that we can change portfolios if we think necessary.
Talk to us about how to confront this negative yield curve, this inverted yield curve. 2-year, 10-year, negative 45 basis points. You're talking about normalization. You're not talking about deterioration. You're talking about 1 or 2 rate cuts. We're not talking about deep rate cutting cycles. So what is the argument for people out there who are looking at a 2-year that gives me 480 and a 10-year that offers 432? Why would I extend duration, go out along the curve? What's the reason for that?
So I think certainly in the US and in the Treasury market, it's hard to really give a good reason why you would go out the curve, particularly sort of between 10 and 30 years. It's hard to see a good rationale for taking that duration risk, as you say, when you can get better carry at the front end. And particularly, as say, for the front end, if we do start to maybe hear a little bit more from the Fed, maybe potentially to cut rates potentially this year, then you could see a little bit of a shift down in yields in the front end in particular. But as I say, the curve is very inverted, and it's hard to see yet a reason for taking duration further out the curve then. That being said, when you look at investment grade, when you look at other areas of the global bond market, then we think it does make sense to take a bit more duration risk. So, for example, in the UK, we're overweight duration. In areas of the Eurozone, IG corporates, we have added a little bit more duration risk there as well. But I think it's about being very, very tactical and very specific about where you choose to take that duration risk.
This is a fascinating point, Tom. I'd love your take on it in terms of, higher yields in the U.S. over the long term. Why? Is it because of inflation or is it because of something else?
And I think that this is where the context part of the conversation comes into play, right? Because, in fact, I think we talked about this when I was on last. I hate the idea higher for longer. It's not higher for longer. It's normal for longer, right? I mean, I think, to me, I've been saying this for a long time, and I think that that's really where we are. If you look at like 100 years worth of yield data, the outlier was the prior 10 years. Otherwise, you're in this sort of like 3 to 5% zone. So to me, again, and if we're right that, the Fed does cut rates, but this is going to be one of these, sort of fairly modest easing cycles, that idea remains true, this sort of normal for longer.
Were you trying to start a Liz Truss conversation again?
I wasn't trying to. I'm just, this is sort of the question, right? I mean, there's also a question of buyer base. And actually, Marilyn wrote about this, about Japanese buyers and what happens if you end up with bank. But seriously, it's...
just so you know, I can read you. I knew where you were going. Marilyn wants in now. Marilyn, your thoughts, please.
Excuse me.
So, I mean, we certainly think that rates will remain higher than the market expected and higher than they have been for a long time. So even as the Fed does start to cut and as the ECB starts to cut, we think it's going to be very, very gradual. And as you know, there's been a huge debate around where our star is. We need to see inflation come down in a sustainable way towards, the various central banks' targets. And it's not there yet in most cases. And so we do think that rates will remain higher than they have been for quite some time, and certainly higher than has been expected both by the central banks themselves, whether it's the summary of economic projections or other things as well, then maybe and also certainly than the market had been anticipated.
Marilyn, this was great. Marilyn Watson there of BlackRock, alongside PGIM's Tom Porcelli. Tom's going to stick with us and get some final thoughts from him on a payrolls report. I happen to agree with you, by the way. I expect a ton of research between now and November that's going to mention things like Liz Truss moment, UK, what happened to the gilt market a couple of years ago, can it happen in this market, in the Treasury market? I'm not saying it will happen, I'm just saying that I think a lot of people are thinking about the same thing, that both these candidates going into November aren't going to tackle the deficit anytime soon. And at some point, I've got no idea when that is, and that really is the $1 trillion question. At some point, this market begins to reject some of the policies they have.
I don't think it has to be the same kind of Liz Truss moment that depends on the currency. What some people are talking about, including Michael Feroli over at JP Morgan, is different, that it's basically a dysfunction of the Treasury market that causes real angst and an extra premium, possibly because the market's just gotten too big, given some of the infrastructure underpinning it. There are other aspects to this that don't sort of look exactly like Liz Truss moment, but rhyme.
You're not alone.
Ms. Musk.
Peter Scheer of Academy is thinking about the same thing. I'm not sure what you said at the end there. Was that Musk?
Ms. Musk. I don't know. It rhymes. It doesn't. It's not the same thing.
Let's move on. All right. Let's get you some stories elsewhere this morning. Here's your Bloomberg Brief with your Hara Hackers. Hey, Hara.
Hi, John. Gold is rising as investors shift their focus to Friday's jobs report and look for clues on when the Fed will cut rates. Lower rates are typically a boon for gold since the asset doesn't offer interest. UBS recently raised its yearly gold price forecast out to 2028. For next year, the bank expects the precious metal to average $2,700 an ounce, saying macro uncertainty and geopolitical risks will continue driving strong demand from global central banks. The NYSE and NASDAQ may be getting some new competition in Texas. BlackRock, Citadel Securities, and other investors are backing an upstart stock market based in Dallas. The Texas Stock Exchange has raised $120 million and plans to file registration documents with the SEC, according to a LinkedIn post by the exchange's CEO, James Lee. He says the exchange will try to entice companies from seeking relief from what he calls increasing compliance costs at the NYSE and NASDAQ. And the NBA is nearing a $76 billion TV deal over 11 years, according to the Wall Street Journal. People familiar with discussions saying deals are on track with NBC, ESPN, and Amazon. The three companies would split games, and ESPN would retain the right to air games on an upcoming direct-to-consumer streaming service in 2025. TNT owner Warner still has a right to match a rival package. The NBA Finals begin tomorrow between the Dallas Mavericks and Boston Celtics. That's your Bloomberg Brief. John?
Yahara, thanks for this morning. Appreciate it. Up next on the program, setting you up for the day ahead, looking ahead to Payrolls Friday with Tom Porcelli. Just a few days away. Equity futures on the S&P positive here by 0.4%, counting it down to the opening bell about 38 minutes away. Here's the trading diary for the rest of the week at 9:45 Eastern Time. We'll get US PMIs, then the big one at 10 a.m. The ISM services data Thursday, ECB rate decision and Lagarde news conference, plus another round of jobless claims. And finally, it's the main event, it's payrolls coming on Friday. Tom Porcelli of PGIM still with us around the table. Tom, let's talk about it. 180, 185 is sort of consensus in our survey. What are you and the team looking for?
Yeah, I think you could be around 200,000. Look, I wouldn't split hairs on the difference between 200 and 185. I think it's going to be a decent number. The one thing that I thought was really interesting from yesterday's JOLTS report, and look, I don't tend to be a big fan of JOLTS. I just think that they have sampling issues and et cetera. But sometimes you can glean something interesting from there. And I think one of the really interesting things was if you look at openings for healthcare, I thought it's been getting dinged like over the last few months. And why that matters is because if you think about what's really been an engine of job growth, it's actually been healthcare. And we've been really trying to drive home the right way of looking at health of job growth at large is to look at cyclical hiring. And cyclical hiring basically strips out healthcare. So if openings are an indication that things are maybe slowing down, you're going to lose what has been one of the main engines of job growth. I think that's a really interesting thing to sort of consider. I mean, it's been adding almost, 80 to 90,000 jobs per month. So, right. So X that, you're averaging 120,000 jobs private, cyclical. So to me, that's an interesting thing to sort of entertain.
You know, we're at the half-year mark. A lot of people are putting out half-year, mid-year outlooks. And I'm just wondering whether the range of potential outcomes heading into the end of the year has gotten wider or narrower for you. Yeah, so for us, we take a probabilistic approach to forecasting, which I love. I mean, it's sort of totally different than when I was on the sell side. You do have these point estimates, and which is just, let's just be honest, like, don't listen to point estimates. But we take a probabilistic approach, and I think it's a really smart way of thinking about it. So we basically have some scenarios, and we assign probabilities to these scenarios. And what we've been saying, and we've been saying this, I walked through the door almost a year ago at PGIM, we've been saying basically since then that we have a really fat tail distribution. And that remains true, as true today as it did when, when I first walked through the door. So I like that idea of really recognizing that there are some pretty fat tails out there around the distribution. I have been saying, and I think that this is, again, as true today, I think that you probably have to go through the left tail before you get to the right tail.
But I like the idea of having fat tail risk out there right now.
Was that some buy-side snobbery? Is that what that was?
It was relief. It was buy-side relief.
Throwing shade.
Yeah. I actually am very
Throwing
curious.
shade.
When you get those messages, send them over so we can see.
Done.
Tom, it's good to see you. Thank you, sir. Tom Porcelli of PGIM. Coming up tomorrow, your lineup. Christian Muller-Glissman of Goldman Sachs, Chris Harvey of Wells Fargo, BMOs, Ian Lingen and Citi's. Veronica Clark from New York City. This was Bloomberg Surveillance.
Welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. Coco Gauff fought back from a set down to take out Ons Jabeur to reach her second semifinal in the City of Light. After losing the opening set 6-4, the 20-year-old found her A game, taking the second 6-2, before closing it out 6-3 in the third. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern.